I think that takes time, and I think what they've done here is things that they needed to do sooner rather than later.
Alex, thank you. Barry, we'll speak to you again soon. Thank you both. Appreciate it.
All right, Nike and Apple among the big names closing retail locations in the United States. Courtney Reagan joins us. She's got more on this front right now. And Courtney, you think this is just a precursor of what's to come?
I really do, Becky. I feel like pretty soon we won't need these lists and we're just going to say everybody's closed. They're going to continue to change these lists, but at least this is what we have now when we're living in this new normal in a country where officials are asking us to limit our gatherings. We're encouraging social distancing, imposing curfews, closing bars and restaurants. So among the retailers that we know right now are closed, mostly here for about 2 weeks, include names like Apple, Nike that you mentioned, but also Under Armour, Lululemon, Columbia, Patagonia, Abercrombie & Fitch, and Urban Outfitters, plus a number of smaller names like Warby Parker, Everlane, Allbirds, Glossier, Away. And again, that's not a completely exhaustive list. The good news is for most of these store employees, they will continue to be paid while the stores are closed. Others are shortening hours. Now, these are mainly grocery stores, which makes sense. They have to have time to be able to restock their shelves and clean their stores. So these names with shortened hours include Walmart and its neighborhood markets and Sam's Club's locations, Publix, Stop & Shop, Natural Grocers, Wegmans, Trader Joe's, and some Kroger stores. Gap, Old Navy, Banana Republic, those are also operating under reduced hours. B. Riley FBR analyst Susan Anderson estimates that annual earnings will fall an average of 18% for the specialty retailers in her coverage as a result of these closures. Piper Sandler analyst Aaron Murphy estimates Nike and Lululemon's annual earnings will fall 2% and 3% respectively. So that's holding up a little better from the closures, while Under Armour's earnings could take a 16% hit. But the big retail lobby groups, the National Retail Federation and the Retail Industry Leaders Association, are telling consumers, quote, retailers, particularly grocery providers, are working with manufacturers, suppliers, and government agencies to make certain essential products and services remain readily available to customers. The groups are also urging customers not to hoard, saying, quote, hoarding products only contributes to the fear surrounding the virus, and any hoarder acting with malicious intent to drive up prices on a secondary market should be prosecuted to the fullest extent of the law. And that is largely, of course, referring to folks that are buying large quantities of things that they are not using personally and then trying to resell secondhand for higher prices.
You saw that story on the front of the New York Times over the weekend about the guy and his brother who had gone around and bought up Purell all over the place, and then Amazon and eBay kind of pulled it so they're not allowed to sell it anymore. Now they've got $17,000 or more of Purell sitting around they can't get rid of.
Yeah, exactly. And I think that's part of the reason why these lobby groups put out these statements, because this sort of fear hoarding sort of begets more of it. It becomes a psychological problem. And so when people see others buying it, whether they want to use it for themselves and hoard it, or it's something a bit more, should we say, malicious, like what you're talking about, it just sort of makes the situation worse. And as we were talking about last hour, all the retailers are working really closely with the supply chains, but also with the government to make sure that all the essentials will be there for us. Yes, we're seeing empty shelves, but that's because people are buying it much more than they normally are. And stores are truly restocking overnight and every day as much as they possibly can.
Courtney, though, before you go, and I know it's something we were talking about last hour as well, as you go down the supply chain, meaning not just the people that are working in retail, and I've been speaking with CEOs all weekend, and one of their real concerns, without panicking people, is that 2 and 3 weeks from now, getting employees to a factory, for example, getting an employee to a warehouse, getting employee may actually become more complicated.
Right, exactly. And so we've been watching what's happening in China to see how that country has sort of rescaled up the workers that are going into the manufacturing or the distribution center, and to see what's happening, because of course we know that they are, I guess you could say, ahead of us with what's going on in the virus outbreak. And so we know that the factories came back online maybe 25% at first, maybe 50% at first, as employees were getting healthy again. But to your point, Andrew, the social distancing. And I'm afraid this is just a new normal. That is a legitimate fear. And I think we all have to watch it very closely. And that just sort of goes even more to the fact that let's not try to buy and hoard more than what we actually need, so that there is enough for everyone, so that there won't be a problem problem because, like you're suggesting, maybe they won't be able to get the normal supply that they would typically get because down the line it's not being manufactured at those same quantities.
Right. Okay.
Courtney, thank you.
Thank you. Meantime, and to this very point that Courtney was just making, store shelves are empty as the coronavirus spread. Shoppers across the country are, I hate to say it, panic buying and stocking up on goods like toilet paper and pasta. Frank Holland joins us now with more on that story. Frank.
Hey, good morning, Andrew. You know, it can take as long as 5 days for a store to go from empty shelves to restocked. In this high-demand environment created by coronavirus, we're at the Morton Williams supermarkets on New York's east side, and those shelves where you would normally see things like pasta, meat, staples like those, as well as paper products. Well, today, right now, those shelves are completely empty. But I have spoken to food distributors, and they say, generally, even in this environment, things like sanitizer and toilet paper, they can be restocked between the next day and one business day after an order is placed with the distributor. However, that depends on when that order is placed, what part of the day. I've also spoken to the Food Industry Association. They say many manufacturers are shipping directly to stores in order to expedite that process. When it comes to things like bottled water and produce, that's normally 1 to 2 business days. But with produce, it really depends on where it's grown and then what part of the country it's being shipped to. A new survey from the National Grocers Association finds that things like sanitizer, toilet paper, and bleach, those are the most bought items, really coinciding with the images that we're seeing on social media and on TV. And sales of sanitizer, they actually spiked more than 300% in the last week of February. That trend seems very likely to continue after the president declared a national emergency on Friday. Keep in mind, sales of sanitizer, they've been relatively flat in recent years. Also, many components that are used to make the bottles, those are sourced in China. Just 2 examples of the shock that this coronavirus outbreak is putting on manufacturers and the supply chain. And that's something that Walmart CEO Doug McMillon really emphasized on Friday.
Specifically, the areas where we're seeing pressure in the supply chain are surface cleaners, cleaning supplies, paper goods in particular. Hand sanitizer is going to be very difficult to have 100% in stock on for some time. We're still replenishing it and shipping it, but as soon as it hits the stores, it's going. The same thing's true for the categories I just mentioned. So all the retailers will be working hand in hand with the suppliers to bring that to the market as fast as we can.
And as this outbreak continues, we've seen the sales explode for shelf-stable items. Those are usually canned goods that are easy to store and easy to ship to stores like this. They've really exploded. Oat milk, for example, those sales have exploded 300% year over year so far. And you can imagine that this coronavirus outbreak and the disruption is going to hit other parts of the grocery aisle. For example, about 1/3 of household goods, those are sourced in China, just under that for pharmaceuticals and medical goods. Back over to you.
Okay. Frank, thank you for that report.
Coronavirus tests made by Roche were granted emergency approval by the FDA. Those automated tests can provide results in 3.5 hours. Joining us right now by phone is the Roche CEO, Severin Schwan. And Severin, thank you for joining us today. It's good to have you here with the program.
Thank you.
This is a huge move forward because testing has been such a huge problem. Why are you able to do this test so much more quickly?
If you look at the diagnostic tests, actually it's a lot about automation and throughput. Roche has a highly automated platform out at labs, but we had to develop an assay, a test for the coronavirus, and that's what we started to do in January. And I'm very happy that after record development time, we could bring this test on these highly automated platforms last week.
Where is the test available? When will it kind of be rolled out, and where would people be able to get access to it?
We got emergency approval on Friday. The tests already left our warehouses over the weekend, so it is already available and in labs as we speak.
How many tests? We heard from the administration last night that I think they hope to have something like 1.9 million tests by the end of this week available. What do you see in terms of how many tests we'll be able to process?
As far as Roche is concerned and the contribution we make, it's initially 400 tests per week. We are, of course, ramping up supply as much as we can to provide relief to the system. But for the first week, we ship now more than 400 tests per week.
Where did they go? Are they going to places in the country that have particular hotspots?
Absolutely. It's all driven by medical need, and for that purpose, we are closely working together with the authorities, the CDC in particular, to allocate tests to those labs and those regions where we can make the biggest impact during this crisis.
Severin, there are a lot of questions because tests have been so hard to come by about who should be getting tested. And right now, I believe the CDC and the WHO guidelines basically say it should be for people who have been in the highest risk or who have been in contact with people who have tested positive for this. Where do you think we'll get, and how quickly do you think we'll get to a point where tests are available for everyone?
I think at this point it is absolutely necessary that the testing is prioritized to high-risk patients or patients who have signs and symptoms like fever, shortage of breath, etc., because there's a capacity constraint. There is simply not enough testing for everybody at this stage. So for the time being, it should prioritize to the patients where there's the highest medical need.
There are some times that the tests come back negative, but a few days later they'll come back positive. Is that the situation with this test that you are just rolling out too?
The test as such is very reliable, but of course what happens is the situation is evolving very quickly. Infection rates are skyrocketing, and as a result of it, a patient who tested negatively one day might test positively the next day. But as far as the test results and the reliability of the test as such is concerned, that is very high. They are very precise tests.
Severin, thank you for your time. We appreciate it, and we look forward to talking to you again soon.
Thank you.
Meantime, Apple announcing all its retail stores outside of the Greater China region, they are closing now until at least March 27th. Take a look at shares of Apple. Let's show you where things stand right now. $245.85. Off right now about 11%, almost 12%. Let's bring in an investor voice on the impact. Joining us right now is Peter Krause. He's the chairman and CEO of Aperture Investors. Good morning to you, Peter. We can talk about Apple, but I also want to talk about the broader market. Let's talk Apple first. To the extent that that's a barometer or a indicator or a signal of something, what is it?
Well, Andrew, I think that Apple is probably a microcosm for what we're seeing in terms of demand impact around the world as a result of the coronavirus. That demand impact is likely to be in evidence for the next few months, and I think you see the markets reacting to that. If you take the human element out of this, which is of course impossible because we're all affected by this, and you look at this sort of objectively, we probably have a 3-month to 6-month interregnum where demand's going to be significantly impacted on travel, leisure, consumption, which is a major part of the U.S. economy, restaurants, hotels, all the things that we've talked about, stores, and that's likely to have and is having a significant effect on the market. So I think Apple is just a microcosm of that demand impact that we are seeing.
Peter, what are you telling your clients? And I remember all too well, unfortunately, 2008 and that infamous weekend that you worked so hard on behalf of Merrill Lynch after having just gone over there. But as you see this playing itself out, you're telling your clients what?
Yeah, it's a great question, Andrew. I've been through about 5 crises or 5 market crashes starting in 87. So it was 87, it was the Russian debt default in 98 in long-term capital. As you remember, I was sort of in the middle of that as well. Then there was 2000, then 2008, and maybe even 2011. This market crash reminds me much more of 1987. Sharp, emotional. 87 markets were actually had a very hard time catching up. They dropped precipitously in a very short period of time. The 98 crisis, it was actually similar in that sense, in that there was very little liquidity in the bond market, and you see that now. 2008 was a different issue, because 2008 you had, in the center of the financial institutions in the world, you had serious questions of viability, that banks were not going to survive, that large financial institutions were going to collapse, that funding was going to dry up, and that banks would not be able to survive that. That was an existential threat to the financial system. We do not have that. We are not at that point.
So you feel confident in the strength of most of the large American businesses today?
I feel confident in the strength of the U.S. and global financial system, and you can see that in the reaction that the central banks around the world have taken, and indeed even some fiscal response that's already starting. As to all of the corporate balance sheets, I think I'm not saying I'm not confident in that, but I think that's a much more disparate and harder to understand.
But look, Peter, I think what a lot of investors are trying to do, and I was talking to CEOs and major investors over the weekend, and they were literally trying to math out if, in fact, because of the social distancing efforts to try to end the spread of this virus continue for many months, what that ultimately looks like, what the balance sheets of these companies look like. Can they withstand it? What happens to the auto industry? What happens to the airline industry? We've talked about the impact, therefore, then on a Boeing, therefore, then on suppliers. You can go down the chain. And as we said, this is unlike 2008 or some of these other crises you're talking about, this very much is a Main Street crisis.
Yeah, absolutely. But you got to think about what's the duration of this. I mean, take the human piece out for a second, because we're very focused on that.
Let's say it's 3 months.
Yeah, well, okay, 3 months. I think most large businesses will survive. Of course, the small businesses are going to be in a very difficult position, which is why fiscal policy has got to be focused on the Main Street economy, and it's got to be focused on those people who will not have jobs and will not have incomes and will not have paychecks, because consumption is going to be at the heart of maintaining some degree of stability in the economy. But large businesses will be able to maintain a demand shock of that magnitude for 3 months. That's not out of the question. Lenders are not going to collapse onto these companies. They may have defaults. They may have technical defaults. And some companies will declare bankruptcy for sure. But 3 months is achievable. The system is not going to fall apart in 3 months.
Okay, so if you're right, if you're an investor today, you look at what's happening, you see where markets are, limit down right now. The ETF suggesting it's going to be worse than that. You're looking at the Dow off pretty much everything about 10% at this moment. By the way, that's effectively just giving up the gains of last Friday.
Which was effectively just making up for the gains of last Thursday.
Last Thursday.
Up and down.
What do you do? Do you put money to work right now? Do you say that there's more to go here? How do you think about it?
So, look, I like to think about these markets as to what their implied risk premiums are. If you go back to 2009, the implied risk premium in the market was almost 900 basis points, maybe 1,000, which implied a multiple at the bottom in March of 2009 of 8.5 times. Now, that's with interest rates at 3 plus. Interest rates now are at 1 or less than 1. And so you could easily have a risk premium here of 6 or 7%. I don't think it requires the kind of risk premium you saw in 2008. And that would imply a 14.5 multiple. And if you think that $160, which is what the S&P earned in 19, is going to be what it's going to earn in 2021, which I think is reasonable, that's a market in the 2,000 to 2,300 as a bottom. So, we're at 25.50, I think, on the futures. Obviously, they're going to go lower. If I had cash today, I would be buying the market in some regimented and disciplined way. You're never going to get the bottom. The market will recover. We've been through this before. I'm not telling you that it's going to be easy. It's not a walk in the park. This is a challenging market. There's not much liquidity. There's a lot of fear. Markets are going up and down 10%. That's not the first time it's happened. It won't be the last. But the global equity markets will survive, and there are interesting investment opportunities here.
Okay. Peter, always good to see you. Wish I could see you on a better day, but I imagine we'll be talking a lot more with you. Thank you.
Thanks so much, Andrew.
The pandemic disrupting travel throughout the world. Over the weekend, the Trump administration extended that European travel ban to include the United Kingdom and Ireland. Steve Sedgwick joins us right now from Heathrow Airport. And Steve, what's it look like on the ground there?
Well, Becky, it's business as usual for the moment, but of course we are talking about 12 midnight Eastern time tonight, local time here in London, 4 a.m. Tuesday, and then that's it for transatlantic travel pretty much. In fact, in the other direction, the UK government has said all but essential travel to the US should not be carried out anywhere as well. I mean, just behind me, travelling out of Terminal 2 at Heathrow, you've got United Airlines, you've got American Airlines, you've got Delta, and they've all come up with some pretty drastic cuts in the last 48 hours. Delta cutting 40% of flights, grounding 300 planes. You've got American Airlines cutting 75% of international flights. United are cutting 50% of flights for the next 2 months. They've already, in March, carried 1 million passengers less in the first 2 weeks than they would normally carry as well. And quite frankly, it's a bloodbath on the airline industry as well. IATA, which is the global airline travel group as well, reckons already it's $113 billion of lost revenues for the airline industry this year. And that's, I think, maybe a figure that's even out of date already. Heathrow, as you all know, is one of the biggest airports in the world. It is the second biggest international airport in the world. Normally carries about 80.8 million passengers. But we had a clue in their February numbers about how bad things can go. February passenger traffic was down around about 5%. But the APAC travel, i.e. Asia Pacific, that was down 30%. And I guess now, when we see the March figures, it's going to be far more devastating kind of numbers than that as well. In terms of what the airlines are saying, well, British Airways, the biggest carrier, of course, here in the UK, biggest carrier out of Heathrow. They pretty much dominate one of the terminals here, Terminal 5, as I'm sure many of our international audience realise. They have said this is an existential crisis. They will be grounding flights like never before. Another one of the big transatlantic carriers, Virgin Atlantic, the CEO, Shay Weiss, has been talking about the need for governments to get involved, and this could be very contentious over the medium term. Short term, of course, it's about keeping these carriers alive. Shay Weiss, CEO of Virgin, saying, look, for the British airline industry, they need £7.5 billion worth of support straight away. That is trying to keep these flag carriers going. And we've just heard from Ryan Air's Michael O'Leary. He's kind of like the southwest of Europe as well. Listen to this. They've just come out and said for April and May, they will cut, Becky, 80% of their capacity. That's an 80% capacity straight away for April and May. Back to you.
All right, Steve, thank you very much. Steve Sedgwick.
Airlines making big changes as demand falls, as we've been talking about, falling sharply, and new travel restrictions are put in place. Phil LeBeau joins us now with more. Hello again, Phil.
Hey, Joe, you heard what Steve was talking about the capacity cuts happening over in Europe. Well, we saw over the weekend dramatic cuts by the U.S. carriers, and pre-market, they're all looking to open anywhere from 14 to 20% lower. Let's talk about those capacity cuts. American cutting 75% of its international schedule. United last night saying that it's cutting 50% of its capacity for the entire system that it flies. And then Delta, 40% of its system-wide capacity also being cut. In regards to United, this was a sobering piece of news from the company last night. Think about this. The revenue that they are receiving, down $1.5 billion. It's $1.5 billion less than it was in March of last year. They're hemorrhaging cash. They're simply having more cancellations than bookings at this point. When you look at American, 90% of its long-haul planes are going to be parked. That's because they have nothing going over to Asia, very little transatlantic, so they only have a fraction of their planes that they're going to need there. And in terms of what Steve was talking about the transatlantic travel here, this was the scene over the weekend. Look, at O'Hare, it was unbelievable. 6 hour waits. Now, Department of Homeland Services says they've increased staffing. That should help. And finally, as you take a look at the airline index, keep in mind that this is only getting worse, guys. It is not getting better. When you talk with airline executives, almost all of them say the same thing. It's day by day worse news. More cancellations than reservations, and they do not see a bottom yet. And that's why we see these stocks going to be opening up anywhere from 14 to 20% lower. Guys, back to you.
Hey, Phil, what does this mean for the employees? I mean, we'd heard from some pilots last week that if the doors don't close, they don't get paid. What happens to the flight attendants? What happens to the gate agents all the way down?
We're now into the phase, Becky, where United last night said they've begun discussions with the unions. We're talking about the flight attendants, the mechanics, the pilots, about some type of a pay cut. The corporate officers are all taking a 50% cut at United. Management will also be taking a pay cut as well. You're going to see this across the board. They have to do this because as they cut their capacity, they're just not going to need as many people working these flights as they were in the past. And at the same time, these guys are in a cash conservation mode. They don't have the revenue coming in. They have to do this. So you will see either furloughs, some type of a discussion happening with all of the airlines, and some tough negotiations that are going to have to be had between the unions and the airlines.
Hey, Phil, can you speak to the implications for Boeing? I mean, Boeing has been its own story for the past several months now, or almost year. But given what feels like a perilous state that the airlines are going to be in, what that ultimately is going to mean when, for example, these MAX planes become available.
Right. Well, the only good news, if there is good news, is that this is happening at a time when they are not delivering 737 MAXs, which are the bread and butter, the majority of deliveries for Boeing. Having said that, Andrew, when this plane is ungrounded and when deliveries are supposed to begin again, let's say in the third quarter, if everything goes as planned, or early in the fourth quarter, you're looking at a number of airlines who might be saying, you know what, we don't have the cash that we used to have. So we're going to have to rework the terms here, either in terms of pushing out our delivery, or we're going to have to work out something else in terms of coming up with the money that you're expecting for us to pay you when we take delivery of these planes. That's a fluid situation at this point. But again, the only good news, if there is good news here, is that Boeing is only delivering wide bodies at this plane, and not a whole lot of them. I think, what were their deliveries last month? 17, 18, something like that. But far fewer than what they will deliver when it's the 737 MAX and those deliveries begin again.
And Phil, the other thing I was going to ask you is, can you speak to the conversations that the industry is having with the White House and others in Treasury? I've been on the phone with several of them, and as you said, there is no travel stoppage right now, but obviously there is concerns that there may be, bad news, maybe good news from a health perspective in terms of the social distancing and trying to stop the spread of this, but the economic damage is clear.
I have to wonder, Andrew, when you have governors in Illinois, California, Washington, New York saying, we don't want people in a restaurant where there's 50, 60, 70 people who are in there. Why would you want 100 or 150 in a steel tube flying across the country? And I'm not advocating for the airlines to have a domestic shutdown. But you have to wonder, since the train is heading down the track in that direction in terms of social distancing. Now, I should point out, I've talked with Eamon Javers repeatedly over the weekend, and when he has brought this up to the administration, they say emphatically, no, we are not going to advocate for a domestic travel ban. Having said that, we're seeing what is going on with social distancing. You have to wonder if that conversation will change.
And the other question, real quick, I think we've got music. Can states declare an emergency where they would limit air travel?
Interesting question. I don't know the definitive answer there. You would wonder. I mean, if a state of Washington says we don't want anybody flying in here, can they do that? I don't know. That becomes a question of regulation and who has control in terms of air service.
Let's do some work and figure that one out, because I think that could be coming soon too.
All right, Phil. Thank you.
When we come back, we're watching the futures limit down this morning, down by 5%. That's as far as they are allowed to trade down until trading opens. But if you take a look at the tracking ETFs, you are going to see some much bigger declines. Dow futures for the Dow ETF now down by 9.8%. The S&P ETF off by 9.7%. We'll have more on the global coronavirus pandemic when we return. Right now, as we head to a break, take a look at the biggest pre-market decliners in the Dow. JP Morgan Chase, American Express, Goldman Sachs, the financials leading the way with JP Morgan Chase down 16%. Chevron, oil company, down by 12.5%, and then Verizon down by just over 7%. Squawk Box will be right back.
Like what you're listening to? Want to make getting back to it easier? Use the favorite button to keep track of the stations and podcasts you love on TuneIn. Just tap or click the heart icon to add it to your favorites. Then find all your go-to audio under the Favorites tab. Pretty easy, right?
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
It's where they raised their 3 boys. Could they downsize? Sure. Will they? Not as long as Thanksgiving is a holiday. Planning for the future is about more than just money. Let Equitable be your guide.
At CDW, we get that trying to simplify data storage can get very complicated. But CDW will assess your needs and implement a Dell EMC Unity XT All-Flash Unified Storage Platform. It delivers speed and efficiency while providing simplicity and flexibility. For unified storage platforms, you need Dell Technologies and IT orchestration by CDW.
I don't like the idea of my broker taking the opposite side of my orders, or selling my orders to high-frequency traders. So I use IBKR Pro. But if you're not sure about your decision, you can switch to IBKR Lite and pay 0 commissions with no minimums and no inactivity fees. Switch again and again. The broker trusted by professional investors is now available for free with IBKR Lite.
Start trading today at IBKR.com.
No one likes to feel stuck, boxed in, or held back, especially by something like your cloud. It's a problem, but the IBM Cloud is different. It's the most open and secure public cloud for business. It can manage all your apps and data anywhere, so it can help take on anything, from rebooking flights on the fly to restocking shelves on demand, without getting in your way.
Market volatility, virus fallout. How will the Fed respond after a week of colossal sell-offs? Insight ahead of the Fed meeting. Strategies before the bell. Squawk on the Street, 9 a.m. Eastern. Watch or listen live on the CNBC app.
Breaking news, futures are limit down this morning, even as the Federal Reserve slashes rates to try and stave off a recession. We've got the latest on the market moves straight ahead. Plus, state of emergency. The federal government, states, and cities across the country take unprecedented steps, shutting schools, stores, and much more.
Good morning and welcome back to Squawk Box right here on CNBC. I'm Andrew Ross Sorkin along with Joe Kernan. Becky Quick is at CNBC headquarters. World's major central banks taking coordinated action to ensure money keeps flowing as the coronavirus outbreak sparks a rush for the U.S. dollar. The Fed, Bank of Japan, ECB, BOE, Bank of Canada, and Swiss National Bank will tap swap lines used during the financial crisis. The BOJ is also expanding its purchase of ETFs and corporate bonds. This in an effort to stabilize markets. Take a look at U.S. equity futures. They are limit down this morning, even as the Fed cut rates to 0. You're also looking, if you look through the ETFs on the Dow, the S&P, and the NASDAQ, looks like the market would open down something on their order of 9 to 10%. We'll also show you European markets right now, also, as you might imagine, down across the board. You're looking at red arrows there. The CAC off about 8.5%. The DAX off a little over 7% now. The FTSE 100 off about 6%. The 10-year note right now stands at 0.783. And finally, WTI, if you want to buy a barrel of oil, the price tag is now $29.88. We've got team coverage this morning on all the issues affecting your money, the Fed, the federal government's response to the coronavirus, and more. Want to get to Steve Leisman and Eamon Javers. They join us, but let's start with Eamon in Washington. Eamon.
Yeah, good morning, Andrew. That action by the Fed that you were talking about last night was exactly what President Trump has been calling for a couple of weeks now. He came to the White House press briefing room last night to praise the Fed, a rare turnaround from his recent harsh criticism of the institution. Here's what he said last night.
It makes me very happy, and I want to congratulate the Federal Reserve. For starters, they've lowered the Fed rate from what it was, which was 1 to 1.25. And it's been lowered down to 0 to 0.25 or 0.25. So it's 0 to 0.25.
Now, guys, we are expecting the federal government to take additional action today. They've scheduled a news conference for 10:30 this morning at the White House for the coronavirus task force. Meanwhile, the National Security Council issuing a tweet overnight to stem some of those rumors that we've been seeing online. National Security Council saying text message rumors of a national quarantine are fake. They say there is no national lockdown. CDC.gov has and will continue to post the latest guidance. So the administration for now saying no national quarantine, no national lockdown, and we'll look to see at 10:30 this morning what else the coronavirus task force has in their announcement that's expected this morning. Now let's get over to Steve Leisman for the latest on that Fed decision. Steve?
Eamon, thanks very much. I've been on the phone this morning talking to senior executives at investment banks about the effect of what the Fed did last night, and so far it's very modest. What they're doing right now is they're waiting and watching to see how the market processes this. So far, the flows from Asia are very light, and so we really can't get an indication. Let me give you some of the bullet points that I've heard this morning. The first is that there has been some improvement in some of the derivatives markets that were dislocated. I'll give you an example. Something that was trading 225 basis points or 250 over the overnight index swap spreads is now down to 150. It was down to 175 last night. Should normally be 25 over. So it gives you an idea of just how much there is to go here. Finally, they're waiting for the Fed to come in and make the purchases. We'll go through what the Fed did in a second, but the main thing is the Fed's going to come in today with $40 billion of Treasury purchases. It's going to be throughout the day, and some of the people I talked to said the effects won't be seen until these purchases are actually made. Commercial paper market, however, is closed, and they are looking for the Federal Reserve to team up with the Treasury to come in and to backstop the commercial paper market. Part of that is because money markets are withdrawing from the commercial paper market. They're concerned about draws on their funds from corporations who provide some of that cash into the money market. These are ways that the financial system is kind of gummed up. Let me go through what the Federal Reserve did. A, cut rates to 0 to 25 basis points. $700 billion of asset purchases, slashing reserve requirements to 0, easing terms and rates at the discount window and for the dollar swap lines. A lot of talk about whether the Japanese banks have withdrawn or need to come back in at some point in time. That's one area I'm hearing. But really, they're in a wait-and-see mode. I think there's general agreement or approval of what the Federal Reserve did so far, but also kind of agreement, guys, that the Fed may need to do more here, and especially teaming up with the Treasury to unclog some of these markets.
Hey, Steve, again, the concern is how the markets are reacting to this, the internals of the market at this point. What do you see? What are the technicals that you've been hearing about with the calls you've been making?
They need to feed it to the floor.
Yeah, I'm just sorry to report, Becky. Sorry, was that Joe?
No, go ahead. I think they're having trouble hearing you. Go ahead, Steve.
Oh, okay. So several people I've talked to this morning say it's just too early. We have flows from Asia. They're relatively light. I'm going to be checking back with folks in about 45 minutes or so. I'm watching the screens I have here. I don't know how indicative they are of actual real trades, but we're not expecting any improvement in the commercial paper market. That cannot remain closed as it's been over the last several days. That needs to open up eventually. But the question is whether or not we have better performance in off-the-run treasuries. Again, these are financial system plumbing things. I am not looking to the stock market itself.
That's what I was going to say.
Whether or
these
not
boards
what
that
the
we're
Fed
watching aren't necessarily telling us any of the things that are happening
I don't
or what
think
the
so.
Fed's actions were designed to kind of address.
I imagine they could improve if you get a signal or some sort of message from these other markets that things are better there. But I think the stock market is dealing with a very, very different phenomenon, and that is, to me, the dramatic change in the economic outlook. Last night, Powell on the conference call said he expects a second quarter decline in output. And you'll remember, Becky, you and I have had conversations over a very long period of time here as we've tried to process this virus and the impact on the economy, and that it was going to be a sort of first quarter weakness, second quarter rebound. Well, that is pushed off at least 3 months and maybe longer.
Steve, I'm very glad to have you running all this stuff down and to be making these calls. We'll check back in with you in just a little bit. In the meantime,
doing the best I can. Thanks, Beck.
Thanks, Steve. Joining us on the phone right now is Allianz Chief Economic Advisor, Mohamed El-Arian. Mohamed, you sent me a note earlier today saying that you are watching very closely what's been happening at the policy level, and at this point you think the technicals are flashing red. Why don't you explain your thought process here?
Absolutely, Becky, and thank you for having me on.
Thanks for being here.
So the fundamentals went from flashing red to constant red over the weekend. We're having now a critical mass in terms of the economic sudden stop. On the policy side, we were going from flashing yellow to green on Friday, and we're now back to flashing red. Why? Because I think that there's a problem with both what the Fed did and what the Fed did not do. As a result of that, and you saw that very clearly in how the futures traded after the Fed announcement and during the media call by Chairman Powell, because of that, we are going to see enormous pressure on technicals. And I disagree with Steve, which I don't like doing. The equity market is actually telling us a lot. What's telling us is we're going to have a disorderly open, and what's going to happen is contagion. When people cannot sell what they want to sell, they sell whatever they can sell. So be careful. We are getting signal of market malfunction. Hopefully it can get sorted out. But I really see red lights across the board. And people should be really careful out there.
You know, Mohammed, we've had a guest earlier this morning, and I've heard it circulated in other places too, the idea of closing the markets. In your opinion, that be a good idea or a bad idea? Generally, you want the markets to be able to flush this stuff out and to be able to react in real time.
Yeah, I wouldn't close the markets unless I absolutely have to. And I absolutely have to if, one, it's a health issue, or health of people there, or alternatively, it is because the market imperfections have become so deep. But if you close these markets, the reset is really complicated.
So your opinion and your advice would be you absolutely have to see this through, even though it's going to be a little messy.
Yeah, and my advice has been what I have said over and over again: do not waste your general policies at this point. Look, we've cut interest rates by 150 basis points. It's the active inertia. It doesn't help, and then you end up doing the same thing over. It's like the American tourist in Paris who says something in English, the French person doesn't understand, and the American tourist simply says it again in English but louder. It doesn't work. This is active inertia.
Wait a second. Do you think the Fed and the other central banks should not have done what they did overnight?
I don't think we should have cut rates. I think we should have been more laser focused on areas of market failures, used much better policies. We have a range of policies that they haven't deployed yet. I would have gone with the laser-like focus and then followed up with the more general interest rate cut when that can have an impact. You know, allowing people to refinance and have more cash in their pocket, allowing people to have cheaper loan, that's not going to change the way people behave. People are scared. People are uncertain.
Mohammed,
it's engaging.
Can we talk about that? And I've been literally emailing all morning and then on the phone all over the weekend with a number of CEOs, government officials, and big investors, all whom are, frankly, as concerned as you are about the duration and depths of this crisis. What may be bad news economically may be good news medically, which is to say social distancing may keep people and keep this virus from spreading or at least limiting it, but the damage may be real. And so the question is, when you start to look at industries that could get hurt if this gets extended out for any meaningful amount of time, what that means, how you look at this. We've been talking about this really, unlike 2008, as a Main Street crisis, not yet a Wall Street crisis, but if it becomes a meaningful Main Street crisis, it could also become a Wall Street crisis.
Yes to all, Andrew. I mean, from the very beginning, was it the end of January or beginning of February, I warned you, this is different. Economic sudden stops are different. And the reason why they're different is because they destroy supply and demand at the same time. Then we had an inherent inconsistencies that you just mentioned. Health policy at this stage is about separation, isolation, social distancing. Our economy is wired for integration, interconnectiveness. So, of course, we're going to sacrifice the economy for the good of the health issues. Of course we are. That's what we will do.
So, Mohammed, then the question becomes, though, if you're an investor today looking at this situation, in large part, you're betting on the policy response. And so the question is, what is the right policy response? You keep talking about it, trying to have a targeted policy response, whether that's from the Fed or, frankly, I imagine from the Treasury Department. But the question is, what does that look like?
So I told you what it looks like. It has three elements. One is sequencing. Any crisis manager will tell you sequencing is critical. In the fog of war environment that you're operating, you have to sequence your policy. Be careful how much ammunition you use when. So phase one is first and foremost protecting the vulnerable segments of society, protecting the most crucial sectors, health in the economy, and ensuring the functioning of markets. Then phase two is you deploy the general policies, massive monetary stimulus, massive fiscal stimulus. Then the second element of crisis management is proper communications. Tell people you have a plan. Tell people what the first step, second step, third step is. And indicate that we will learn as we go along.
Where are we then, Mohammed, along that spectrum that you're talking about?
We've gotten the sequencing wrong. We have deployed the general policies when they will not have an impact, and therefore we have used valuable ammunition, Andrew, valuable ammunition. You know, I tweeted last night that I was both baffled and upset by what the Fed did. Right. Baffled because it's clear to me that it's not going to address the market failures, that they're going to have to rush with another set of policies that are much more targeted.
Mohammed, Stephen Mnuchin has talked about going to Congress this week for the ability to bail out companies, rules effectively that limited his ability to do that post-2008. What does that look like, and how, to the extent you can get ahead of it, even though we're behind it, how would you imagine that would work?
So first, I think it's important for the Treasury to realize that the line asking for bailouts is going to be very long. The airlines are a leading indicator, but what they're going through is what others are going to go through. Restaurants are going to go through the same thing. Cruise lines have already gone through the same thing. Industry after industry is going to go through the same thing. So you have to have a basic understanding of what your principles for bail-in is. Not just who you bail out, but importantly, how you bail out. You don't want to protect everybody that's invested in companies. You've got to be very careful as to how you bail out. So before you go ask for authority, please have principles as to who you're going to bail out, why, and how.
All right, Mohammed, we are going to talk to you a little later this morning because that's kind of the stage we've reached. We need to check in with people routinely every hour. We'll check in with you before the opening bell. You can go back and monitor things and bring us an update with this, but we really appreciate your time today.
I will. Thank you, Becky.
Thanks.
Okay, meantime, U.S. futures, as we mentioned earlier, triggering limit down. Joining us right now on the phone is the SEC Chairman, Jay Clayton. Chairman, we appreciate you joining us on this morning. What are you seeing in the markets and the functioning of those markets right now?
Good morning, Andrew. And look, thank you to you, Becky and Joe, for doing a really nice job of framing the issues that we're facing. Look, we have futures limit down. This is something that we experienced a couple of times last week. We will, be monitoring that. When we had the circuit breakers tripped last week, markets functioned well on the reopen. We were very pleased to see that. And we've been in contact with, the various institutions across the street. I'm happy to answer your questions, but things have been functioning well in our markets over the past 2 weeks of a very volatile time.
Chairman, there have been some speculation or at least questions raised about whether the markets may have to be shuttered or should be shuttered. Can you speak to that? Has there been any contingency planning in that regard?
Look, I think your previous guest, Mohammed, did a nice job of saying that what I believe, which is the Treasury Secretary believes, which is markets should continue to function through times like this. I can tell you that we have been working with what I will say is the critical market infrastructure entities to make sure that their business continuity plans, Andrew, match up with the health and safety plans. I mean, all of your guests has emphasized this. I want to emphasize it. Health and safety is paramount. We need to make sure that our business continuity plans work with the health and safety measures that federal and state governments are putting in place?
That's an interesting question because obviously we all agree with the markets being open too. Mohammed just talked about that. The one exception he did have would be in case of a health issue, if it would not be healthy for people to be there to operate these markets. What have you heard back so far? These can be done, the markets can be kept open with the very skeleton staff?
Yeah, Becky, that's exactly what we've been focused on since, I would say, early last week in consultation with the exchanges, clearinghouses. We have two options exchanges going to all electronic as of today, the CBOE and the PHLX. We've been in contact with the New York Stock Exchange, and it's not just the people you see on television. It's also the people that operate the systems and do the necessary patching. I mean, through all of this, things like cybersecurity and system functioning and updating, those all remain important. And we've been in contact with these various players in our marketplace to make sure that they have the people in the places they need to keep those things going.
Chairman, Robinhood, which is one of the many trading services, more of an upstart, but which has clearly caught on with millennials, has now had at least 2 days where they've not been able to operate. What do you tell investors and consumers out there who may be on these services?
Look, Andrew, anytime you go through what I would say is a massive transition. We here at the SEC transition from having roughly 3,000 people coming into headquarters to mandatory telework over the last week. Anytime you have a transition, you are going to have system bumps in the road. I'm not going to speak to any particular business or entity, but people should expect bumps in the road. We're going to deal with them, as the Treasury Secretary said over the weekend, we're in the early innings, and we're going to face things like that. The idea, as Mohammed said, is let's face them head on, let's communicate, and let's move forward.
Mr. Chairman, you lived through the financial crisis. You were at the center of it, working with many of the banks at the time. How do you view this situation personally?
Yeah, look, this is we can look to the past for guidance in situations like this. You can look to 9/11 with the business interruption there. You can look to the financial crisis with the real risk at the heart of our bankings and our financial center. But it's not the same. You can take guidance from it. I think our banks are in a much stronger position today than they were then. This is as Mohammed said, this is a demand and supply shock. What I'm looking at here, and I think we're seeing a coordinated action, is our credit markets and making sure that our industries, have access to the credit they need during what, for the next period of time as we get a better handle on how long this is going to be is an uncertain time.
But that was I think the part of the question therefore becomes, when you look at the balance sheets of these companies, we talked about the airlines, hotels, et cetera, how long, and maybe even automobile industry, how long, if there really is a demand shock and it's a shock that lasts not just weeks, but perhaps months, what that ultimately means to the health of those institutions.
Yeah, so let's just go over what we talked about already today. We talked about systems and operating today. We talked about credit markets generally and normalizing the treasury market. Now you're moving into each company, and I can tell you, Andrew, each company in America and probably across the world has been doing a cash flow analysis over the last few days. How much cash do they have? How much do they expect will be coming in light of the supply and demand shocks? And trying to plan out. And as your prior guests have noted, that becomes an idiosyncratic and targeted. You can target it by industry. You can target it by firm, to provide them with the resources that they need to get through what will be an uncertain period. That's the way I look at it.
Investors invariably are looking, though, at what the policy response may or may not be. Treasury Secretary said this weekend that he was going to go to Congress to get some of those bailout powers that the Treasury had in 2008 back. What does that look like to you?
Well, I know that over at the Treasury and the White House, and in coordination with the banking regulators, they are working on the toolkit. And as I said, I don't think that this is the same as 2008, but to the extent that those tools can be deployed in a way that makes sense today, I am sure that they will be asking for them. I was heartened as a citizen by the bipartisan support for the bill that went through last week. Look, I agree with your prior guess that we should be using the tools that we have at our disposal to get through this unprecedented period.
Treasury Secretary said that there would not be recession. Is that right?
Look, Andrew, you've known me a long time. I don't pick prices. I don't pick anything. My job's about function, and I'm going to stick with that.
Mr. Chairman, we appreciate you calling in, and we hope to talk to you again throughout this process. Thank you again.
Thank you for the time.
Thanks very much.
At the NASDAQ, telling investors that its systems remain fully operational and new listings and IPOs will continue to go on. Join us now, Adena Friedman, NASDAQ President and CEO. Now, normally we'd have Adena on set with us, but we're trying to be responsible and practice social distancing. So you notice we haven't had any reporters or guests on set with us today, and we have limited production crew around us, and that extends to everyone, including even the boss here at the NASDAQ. Adena, it is good to see you, nonetheless.
Thank you for having me on.
You're very welcome. What is the NASDAQ, you and the NASDAQ, how have you decided in terms of continuity through this, however long this takes?
Sure. Well, last night we made an announcement that tomorrow, effective tomorrow, we will be closing the PHLX floor. That's an options floor. And we are doing that specifically to make sure we're playing our role in the social distancing and to protect not only the people who are on the floor, but the communities that they operate in as well. But we, as an electronic market, across all the markets that we operate, we can operate our markets remotely. We do have, for the last couple of weeks, we've been instituting split teams and rotating teams, as well as encouraging our employees to work from home. For the market operations themselves, we do have teams, a split team environment, and they can operate the markets remotely. Right now, we are still operating on a split team environment with certain people coming into the office and certain people working from home. But that is the benefit of the electronic markets that now exist in this country that allow us to manage our markets in a social distancing environment.
We've been talking a lot about the different infrastructure in both fixed income and in the equity markets. In terms of dislocations or things that aren't orderly or problem areas, what are you seeing at the NASDAQ?
Well, I think that in terms of the equities markets and the options markets, because they're so transparent and electronic, they're so connected, and every trade gets reported in real time, I do believe that we have seen certain momentary dislocations, but also a relatively orderly process of managing investor sentiment. The issue, of course, is that there is a supply and demand imbalance, and we are seeing that reflected in the markets in real time. I think in some of the other markets, the credit markets and the rates markets, the market structure is different. The level of liquidity needed is different. And as you can see, the Fed is taking action to manage the liquidity in the markets to make sure that they continue to function with the liquidity that's needed.
And we've been asking various people. We just asked the SEC commissioner about the possibility of ever closing the markets or a hiatus in trading. What would your feeling be on that? Most people say if there's a health issue, maybe you would do it, but it'd have to be a last resort.
Right. In our view, it is critically important that the markets continue to operate, that investors continue to be able to express themselves in the markets. But also, even last Thursday, during the very challenging markets we experienced, we did have a small healthcare company go public. And it is important, therefore, also to remember that the markets are there to give companies access to capital, particularly companies who are working with this virus and managing through this situation. Having access to capital on a ready basis is critically important to fund their operations. So we do believe that the capital markets should remain open throughout this process, and we will be here to make sure that we do our part to keep our markets open.
You had a new issue, but in general, how much has activity been hampered, and do we have how badly will the NASDAQ business be affected? What type of I guess you're going to have lower numbers than last year at the same time in the quarter. What type of decline are you looking at?
Well, in terms of IPOs, we've had 27 IPOs so far this year because we had a very fast start to the year. But we certainly are seeing companies now putting their IPOs on pause. They are still filed. We have actually the same number or a little bit more filings ready to go and waiting than we had last year. However, I do think that they obviously will be working with their underwriters and will be talking to investors to understand how receptive are they to coming out into the market in the coming weeks and months. We do obviously hope that with the social distancing we're doing and all the work that the country is doing right now to manage through this crisis early, that we have an opportunity to continue to see if we have, we can kind of restart things as the year progresses. In terms of NASDAQ, we have a very resilient business model. We have a lot of annual and recurring revenues. The annual fees are paid in the beginning of the year. So for the listings that are on NASDAQ, and of course, trading volume does impact our revenues. So our business model is quite resilient in times like this.
Hey, Adena, I want to ask you just as a CEO, because the CEOs I've been talking to, some of them have said this is the most complicated thing they've ever tried to manage in terms of how do you figure out how to continue to run operations while you don't have people who are coming in? How do you do everything remotely? How has that kind of played out in your shop?
Sure. Well, the first thing I would say is we're a global business, so we use video conferencing and remote management on a regular basis. It's, of course, better to have teams together. It's, of course, better to have managers working with their teams collaboratively in the same location. However, we have managed through remote management in certain circumstances in the past. It is complicated. We start every day talking through our employees and making sure we're keeping our employees safe. We then move into the markets and manage through the market open and through the markets in these very volatile times. And then we finish the day planning for the next day. So it is definitely a complicated period, but we do believe that we're prepared. And we've had to manage through other shocks in the past that have made us much more prepared for this one.
We exit the set very quickly at 9 a.m. because we turn it back to the NASDAQ. And usually there's a big to-do in here. There's confetti. There's lots of people around. There's none of that right now. I wonder how long you see this situation last night. I know nobody knows, but when will we see someone enter our set? We're not really thrilled to have anyone come at this point. We like that no one's been in here, but when do you see that loosening up, do you think?
Well, I think that right now we're making sure that we manage to a new environment for marking the market open and marking the market close with an event of some sort. We are working towards a remote event, so I think that we can try to continue to make sure that we mark the open and the close of the market. In terms of returning to any sort of sense of gathering, I think that that's anyone's guess at the moment. I think that right now the goal is to try to create social distancing, to flatten the curve, and manage through this situation so that we can actually come back into a more normal environment as quickly as possible.
Adena, you talk to a lot of other CEOs because of your unique business line and being in contact with so many of them. I've been, I guess, surprised at how quickly this is developing, changing not on a day-by-day basis, but basically an hour-by-hour basis. What do you hear from those CEOs without giving away any conversations you've actually had with them? What's the overall sense that you've gotten?
Well, it really depends on the industry. So I have actually spoken with a lot of CEOs, and depending on the industry, they can be just completely impacted in every part of their business, or they're yet to really see the impact to their business. So if you're in a B2B software business and you have a very steady and stable revenue stream, you're likely to feel pretty good about the recurring revenue that you have in your market, in your model, but you may not be able to get new clients to focus on that part right now. Whereas if you're in, obviously, the hospitality or travel industry, you are just materially impacted in every element of your business. So it really does depend on the industry. The other thing I have heard is supply chain issues are starting to manifest themselves depending on the industry and depending on how much they're relying on other parts of the world to manage their supply chains. But we are going to start to see that filter into the economy in the coming weeks.
All right, Adena, thank you very much. Great having you on today, as always, and we look forward to that point in the future where you're back with us here right on set. Thanks.
I look forward to it, too. Thank you very much.
You're welcome.
When we come back, retailers closing their doors amid the coronavirus outbreak. Retail analyst Brian Nagel will join us next.
people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
Between game-winning shots and walk-off home runs.
Pitch. Swinging a line drive, slice down the right field line toward the corner. Looking up, and this one is gone!
Follow TuneIn on social media to stay in the game. From live reminders of the biggest games in every league, to staff pick recommendations of our favorite sports shows and podcasts.
Yeah, but you're really greedy, Dak, but nobody's thinking that yet.
You know how these contracts work. All that 40 years for 5 years for $200 million.
Follow at TuneIn on Facebook, Twitter, and Instagram to hear more sports.
We see engineers simulating the future to improve today. At Emerson, when issues become inspiration, creating a better world isn't just a result, it's a responsibility. Emerson. Consider it solved.
Driverless cars or trips to Mars, no commission. Delivery drones or the latest phones, no commission. No matter what you trade, at Fidelity, you'll pay no commission for online U.S. equity trades.
NBC Nightly News with Lester Holt, covering coronavirus with facts over fear.
How do we know who belongs in isolation? What should we be conscious of? What's being worked on today?
At a time of crisis, turn to the most trusted TV news anchor in America.
Hey, guy, ED issues? We got this. Today's your day. Go to forhims.com/ED.
Selling a home is expensive and stressful. So we set out to create a better home selling experience with a network of the most successful real estate agents in America that'll sell your home for as little as a 2% commission.
The icing on the cake with the ideal agent was that we saved $12,000 in commission.
They were so stress-free. The whole process was amazing, and I would definitely recommend them.
We are not a discount brokerage. These are top local agents that'll get you the best results.
Banking with Chime is honestly one of the greatest things that's ever happened to me financially. Not waking up to hidden fees or miscellaneous charges. My name is Tibian, and I love banking with Chime.
Start banking with Chime today at chime.com.
Welcome back to Squawk Box, everybody. The futures are limit down this morning. That's down 5%. That's as much as they can go. That's why we've been watching the ETFs this morning. That gives you a better indication of where market sentiment really is. Dow ETF down by 10%. The S&P ETF right now off by about 9.5%. We've been watching all of these. After the opening bell on Wall Street, of course, circuit breakers can kick in. That would halt trading for a period of time. The first halt would be as if we're down 7%. The decline would be a decline of about 189 points for the S&P if that were the case. We'll continue to watch this. But Mike Santoli joins us right now with more of what he's been watching this morning. Hi, Mike.
Yeah, Becky. In fact, looking to handicap the open and also put that in a bigger picture frame in terms of where that places us relative to the last couple of years. This is the S&P 500 ETF, the SPY. It does show the pre-market action, as you were just mentioning. And so obviously we're going to go through those lows of last week. Pretty close and not necessarily to the intraday lows of where we got to in December of 2018. I do think it's important to recognize that as of 3:35 on Friday, we were at about 255. Right. So in other words, we had this huge ramp in the last 25 minutes of trading on Friday. We're giving that back and more. I'm hearing a lot of folks in terms of looking at target areas for where this might settle out is certainly people are now thinking it's a pure liquidation. So we're going to get probably to or through those December 2018 lows. As you can see, by the way, this was a 20% decline over 3 months. This is a close to 30% decline over 3 weeks. So this is crashy. This is not sort of typical correction or bear market behavior simply because the markets remain open. It's where you can basically act on your uncertainty about the outlook. Now, here's a comparison of 3 three big ETFs, the S&P 500, the NASDAQ 100, and the Russell 2000. What you're seeing here is not a lot of differentiation, except if you thought that the big problem with the market in late January or early February was that the big NASDAQ stocks were too much of the market and they were too overvalued, and that was your bear case, it hasn't helped you at all to be negative on those relative to the others, because it really has taken everybody down, and in fact, those guys less than the others. The rule has been the more global industrials, the more financials you have and transports in your index, the worse you have done. Obviously, guys, what we're looking for now is to gauge just exactly how indiscriminate the selling is, what the intensity of it is compared to the worst day last week on Thursday, and just to see if you're seeing any effort of the market to differentiate between things that have been punished too much and not enough. It might not be today's business, but that's the process, and much like in October of 2008 that we went through.
Hey, Mike, just on that front, being indiscriminate, any signs of that in the futures this morning, or in the pre-market trading for futures stocks?
Yeah, it's essentially just it's a move to cash right now. I do think what you're basically seeing is there's a massive loss being built up in the overall economy. The only way you can register that loss or essentially try to get out of the way of it is through the public equities market. And so I think you're almost certainly eventually we're going to overshoot. Maybe we have overshot in terms of registering exactly how much of this matters for public equities, but that doesn't mean the process stops just when you get to that moment. So right now it doesn't seem as if there's a lot of picking and choosing. At some point, the day's going to come where you're going to say, well, look at these 8 Dow stocks that have dividend yields of 3% that are safe, and that kind of process will begin. I'm not sure that that's what we're up to today. We have really the market reacting to itself, in a sense, reacting to credit markets, reacting to the stresses and illiquidity in the rest of the system, and hopefully the Fed's actions today maybe is going to ease some of that. That'll probably be the first thing we're looking for.
All right, Mike, thank you. We'll check in with you in just a little bit. In the meantime, joining us on the phone is Eric Knudsen. He is multi-asset CIO at Neuberger Berman. Also, Janelle Woodward, who's the head of fixed income at BMO Global Asset Management. Eric, let's start with you. You're watching this morning. What are you thinking?
We're thinking that what the Fed did last night may help heal Treasury market liquidity, but it hasn't addressed credit market liquidity and the real concern here, which is that this is not a financial crisis. This is a growth shock, and I think that point was made by several of your guests earlier this morning. And while it's very important for the Treasury market to regain normal functioning because investors need hedges, as long as the credit markets are dysfunctional, as long as you see the gap that Mike just pointed out between the Russell 2000 and the S&P 500, where the real issue, the real concern is around smaller companies, around the real economy, around businesses being able to finance their activities over the next several months, we're not going to have clarity on how we get through this episode.
Janelle, what are you seeing in the Treasury markets this morning? What kind of dislocations, or did the Fed actually help things? And what do you think is going to happen today?
Certainly a move lower in yields, which to us signifies another significant risk-off day. It's a little bit too soon to see how credit spreads are going to move. I think when we look at the action over the weekend, it was significant. It may not completely alter the tone of the market, but it was necessary. I think the Fed has been in this case where in a risk management framework, it's been responding exactly to what the market needed. And when we look at some of the liquidity challenges in the market last week, it really had to step in and be ahead of expectations. And so this wasn't just about cutting the target rate, but also what it did with a primary credit rate, encouraging banks to really step in, as well as restarting asset purchases. So it may not fix everything and change the tone, but it was absolutely necessary in our opinion.
Hey, Eric, I just wanted to go back to what you mentioned, and it's very true. Based on all of my reporting, this is a Main Street crisis at this point, and that's what people are looking at. My question to you, though, as an investor is, so much of this is going to be about a bet on what the policy response is going to be, which is to say what the Treasury Department and or what you think the Federal Reserve may or may not do over the next several days and weeks. And so how do you make that gamble?
Well, This is, I think, gambling is the right term. I think that absent a clear view of fundamentals and a market that is actually related to fundamentals, it's very hard to kind of pick levels and assess kind of more short-term trades. I think from a policy standpoint, what will make a difference is not necessarily classical Fed policy, because lower rates aren't going to help small businesses. The Fed buying corporate debt, corporate credit could. Now that requires some change in regulatory framework or structural framework, but it's already happening in Europe and Japan, and that's been successful. But it's really going to have to come from the fiscal side. And an example is what Germany did, making $600 billion available in credit for the business sector in Germany. A similar type of approach in the U.S. or targeted fiscal policy to support
Eric,
small businesses will be helpful.
If the government came out and said that they were going to make the equivalent of a bridge loan, if you will, available to small businesses across the country, and again, the mechanics of how you would do that would invariably be complicated, how much confidence would that add back to the market, and how much confidence would it add back to the country?
I think those are the kinds of steps that will help people gain a sense that they can get through what is looking like it should be a temporary situation, but which can become a longer-term crisis if you see kind of massive stress in the smaller company, small business area.
Hey, Janelle, in terms of the response that we've seen, this coordinated effort coming from the central banks, does that give you additional faith, the idea that this is now being tightly coordinated?
I think the coordination is important. And I think to the earlier comment, it's not just about global central banks continuing to step in. It is also about that fiscal piece. And I think what needs to be appreciated and what's different is that this is the first time we've been through a crisis where we have the regulatory constraints on bank balance sheets. And so I think as a first order effect, it's really we need to be able to figure out how we can support banks in lending and extending credit. Again, the solvency isn't about banks themselves, which is what we saw during the financial crisis, but that next layer down. And so the Fed can support that, but we actually need tools to directly reach the businesses that are most at risk.
All right, Janelle, Eric, want to thank you both.
Okay, meantime, Apple, Nike, and Under Armour, just a few of the retailers announcing store closures to prevent the spread of the coronavirus. And joining us right now to discuss this and the impact is Brian Nagel, Oppenheimer and Co-Senior Equity Research Analyst. Brian, it's good to have you on the program. Just math it out for us as you look at these companies, and most of them are big, and I think they can handle it. But if this were to go on for not just weeks, but let's say months, let's say 2 to 3 months, and some people have sent me tweets saying 3 months is too short, so I don't know what your number is going to be. And you look at their balance sheet, how long can this go on, and can they handle it for, Brian?
Well, good morning, Andrew. I think that's a great question. And, I'm obviously, just like everyone else, looking very closely at all this news that's coming out over the weekend. And so I'm thinking about Nike, and just to focus on them. So Nike said that those stores will be closed now, within the United States and other markets through March 27th. Look, Nike financially is very, very solid. So there would be a point at which it would be stressful, but I don't foresee that. I mean, the way I'm looking at this more is I think Nike's doing the right thing. I think they're moving to protect their employees, their customers, and really do their part to, help this transition to social distancing with our country. The big question for me is just, when that consumer comes back. So these stores are closed for the next 10 days or so. Again, let's see what happens. But if the consumer comes back, the consumer can come back really fast. And that would be a positive for Nike. The other big positive, a lot of these companies now, and I know we talk about this a lot on your show, is it's not just stores anymore. They have got really well built out what we call omni-channel operations, whether e-commerce or others. So right. It's not going to cushion blow completely, but that does help.
I think there's two issues, and look, and maybe we're talking to the same executives over the weekend. When people talk about 3 months, they're not just talking about the stores being shut, they're talking about demand. And we're not just talking about demand in the United States because this is now a global issue, so we're talking about demand across the world, frankly. And then the question is, you talked about e-commerce. Right now, there hasn't been a genuine supply chain shock, if you will. E-commerce is still, Federal Express and UPS are still delivering things to people's homes. The warehouses at Amazon and elsewhere are still working. The distribution centers are still working. I think the CEOs that I've been talking to the extent that I've heard any panic, it's what happens 2-3 weeks from now when the social distancing, which may very well be necessary for the spread of this virus, forces them to either shutter or to slow down or limit that activity and what that looks like.
Yeah, okay.
And I don't know if that's in the market. I don't know if the public really appreciates some of that. And again, I don't mean to panic people, but these are the conversations I'm having with some of the CEOs of the largest companies in America right now.
Look, and I can say what I'm hearing from you is I'm talking to our clients right now. It's difficult to say for sure at this point, but I would say generally speaking, for what it's worth, the investment community, people looking at Nikes from an investment standpoint are trying to assess exactly the question. They're not thinking 3 months at this point. They're thinking something shorter than that.
And do you think that that's appropriate? Look, do it this way. Schools in New York right now are closed at least, I believe, for the next 5 weeks. Minimum. And the question is whether you think that's coming to every city and state in this country. That's the question, and that's just the United States. We haven't talked about the UK. We haven't talked about Spain. We haven't talked to, obviously, Italy. France is shut down. This is why, these are some of the conversations that policymakers and CEOs have been having on conference calls all weekend long.
And from my vantage point, doing what I do, it's difficult for me to say. I just don't know. I mean, I don't know how long this would last. But I can say, I think these companies like Nike are doing the right thing. I think they have, they're financially strong enough to weather this. Obviously, there would be a point, but I think they're doing the right thing.
Okay, Brian, we appreciate your time. Stay safe out there.
Thank you.
All right, folks, it's not just the equities that are being hit this morning. You want to take a look at what's been happening with gold prices, with oil, with Bitcoin. Let's start with gold, because a lot of times when you see equities for sale, you will see other markets that are picking up and being safe havens. Gold's usually considered one of those, but this morning, gold's down by 3.7%. That's a decline of $56 an ounce down to $1,460 an ounce. Also, oil prices obviously reacting to what the economic shutdown could be around the globe. And right now you are looking at WTI below $30 a barrel. Again, it's down another 7.9% almost to $29.23 a barrel. Bitcoin this morning, last I saw, was down by about 15%. You're going to see right now, 14 and a half, a little bit more than that. Also, a quick headline that just came in from American Airlines. We had talked with Phil LeBeau earlier about what's going to happen to the employees, whether they'd be getting paid. Normally, employees are paid based on the number of flights that are out there. As these airlines are all shuttering the number of planes that they're going to be taking out, bringing in all of that, American Airlines and their pilots say that they have agreed to terms for coronavirus sick leave, and pay protection. We'll talk with Phil LeBeau about this a little bit later. But again, that's what's been happening with other markets as well that we've been watching.
Okay. Hey, Becky, thank you for that. Meantime, we're going to get the latest on the coronavirus outbreak. I want to get over to Kate Rogers. She joins us now with more. Kate.
Hi, Andrew. Good morning. Confirmed cases topping 169,300 worldwide with more than 6,500 deaths. Europe is now the center of the pandemic. In Italy, hardest hit outside of China, officials on Sunday reporting the number of deaths jumped 25% over the prior day. That's the biggest uptick of any country yet. The number of deaths there now at 1,809. The U.S. adding the UK and Ireland to its European travel ban, and the CDC recommending the cancellation of events with more than 50 people for 8 weeks. State and local officials are issuing new restrictions aimed at curbing the spread of the virus. Schools closing in 33 states, California, Ohio, Massachusetts, and New York City closing bars and restaurants as well. America's top infectious disease official, Anthony Fauci, urging Americans to stay home, saying that new guidelines on curfews and social distancing will come out today, warning of a spike in deaths if behavior does not change. And the White House's coronavirus task force promising a major increase in the availability of testing this week, rolling out 1.9 million tests to 2,000 sites. With that, an increase in confirmed U.S. cases now at more than 3,700 and deaths at 69 is expected. For much more on all of this, check out CNBC.com. We have a coronavirus live blog that we continue to update throughout the day, guys. Back over to you.
All right. Thank you, Kate. For more on For more on the U.S. fight against the coronavirus, let's welcome Dr. Corey Hebert, assistant professor with LSU and Tulane University. He's the CEO of Community Health TV. Dr. Hebert, thank you for joining us.
Good morning.
From where you're sitting, we've had a lot recently about testing and about social distancing and a lot of closures, et cetera. Do you think at this point we are going to be able to bend that curve that we keep talking about? Are we going to look more like China or more like Italy at this point?
Well, if we do what we're supposed to do, we really should look more like China and hopefully even one of the countries that are doing a little bit better than China. Basically what your viewer is pretty savvy, so they're used to watching graphs and they see this flattening the curve graph, and I don't know if they really understand what we're trying to do here. So if you look at a curve on a graph, you're going to see a spike and then you see a line that actually goes kind of flat. And basically what social distancing is trying to do is to decrease the amount of people infected at one time under the curve. So bear with me here, understand. What's going to happen is if you had 150,000 people, that's the spike that would be infected. That's the spike. What we're trying to do is instead of having 150,000 people sick at one time, which would overburden the medical system, we'd rather have 10 people sick, or 10,000 people sick rather, over a longer amount of time. So 15 days. Making sense? So we don't overburden the system that is already overburdened. So at the same amount of area under that curve, whether it's flat or it's spiked, still 150,000 people, but we want them to be very stratified as opposed to at one time. And that's what social distancing does. Social distancing makes it so that everybody will be exposed, who will get exposed over a longer period of time as opposed to one moment in time. And so that makes the system able to handle that capacity.
We understand that. That one of our great fears, again and again, has been that we're unable to really affect the same type of actions that a country like China, a communist country that can basically enforce these quarantines, and that we have so much liberty here, social liberty, that we're not going to be able to do it. Do you agree with that? Or, I mean, some of the things that we're doing now seem pretty close to what happened there, and will, since it's going to take more voluntary initiatives over here in the United States, but I think you're seeing some of that too, just out of pure fear for a lot of people. So we might be able to replicate a better case scenario than what we're seeing in parts of Europe.
Yeah, and the reason why is because we know public health is a four-legged stool. Basically, it's public outcry, it's politics, it's economics, and then it's science. Most of the time, those top three rule the day, and science is probably at the bottom because people get very upset and they get nervous and they get panicked, which, just to let you know, increasing panic increases cortisol, which is a steroid, which also makes your immune system worse. So the more you panic, the more you're apt to get the disease. But we want science to rule the day. And what we know is when we look under those curves, science will state, because of the infectivity of this virus, that the amount of people will be decreased if we quarantine, if we keep people from having big social gatherings. And that's what we need to be doing.
Dr. Hebert, a lot of investors have looked at the charts over the weekend trying to figure out, when and where this peaks and whether we'll be able to flatten the curve. And, Governor Cuomo here in New York is calling for basically the National Guard and the Army to start to build hospital beds and hospitals. Yes. This state only has 3,100 ICU beds in the entire state.
Sure.
Do you think we have a handle on this?
I do. I think it's probably going to get worse as far as what the public thinks and the infectivity of the population, because the testing is going to be readily available now after, way too long. We don't have to go there. But the point is that I think that this is going to, as the cases go up, people will start to feel comfortable that the cases are going to go up. And that's what I want people to understand. As the tests come, the test will be positive because we're only testing really people that have been exposed at this point. The testing numbers will go up and people will start to feel like, okay, my cousin was exposed, my cousin has it, my girlfriend has it, everybody has it, but nobody's really getting really sick, because we have to remember that about 50% of people won't even have a symptom when they have a positive test.
But Dr. Hebert, we keep hearing about, and there are some idiosyncratic cases. Jim Stewart, who's a friend of this show, put out a tweet last night about a friend of his, I believe in Spain, who's 40 years old, who's in a coma. So I'm just trying to understand how you see this without an underlying condition, by the way. how you see this playing itself out. Again, I don't mean to panic people, but I think people are trying to understand really what this means from a medical perspective.
Right. So what I want people to understand is that when we have this, my friend had this, my friend had that, as a physician, we can't look at things like my friend had this and my friend had that. We have to look at how many global deaths are there. Less than 10,000 global deaths. There's almost 1.5 billion people in China. Think about that. So when you look at 5,000 deaths, 6,000 deaths, 7,000 deaths. Don't get me wrong, everybody's life is important. But when we look at this statistically, that number is extremely low compared to the amount of people that have died in the United States or will die in the United States from influenza every year. Right. So I just want people to kind of wrap their minds around, that number to know that this is going to be okay. We're going to ride this out.
And Doctor, one of the reasons we're worried about hospitals is because they're still overloaded with people from the flu, and we haven't we weren't talking about that at all, that the hospitals were overloaded with current flu season people already, which is bad, but also shows that we weren't talking about that, and people now we're talking about this. Well, thank you, Doctor. We appreciate Dr. Aber. We appreciate it. We'd like to have you on again soon if we could.
Absolutely. Thank you.
Thanks.
Still to come this morning, more of this special breaking news coverage on CNBC. Futures hitting limit down shortly after opening last night, but market ETFs are pointing to a much sharply lower open. Dow ETF down by 10.5%, S&P ETF off by 9.75%. Stay tuned to CNBC. We've got more special market coverage coming.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn on the App Store today.
Over a year, and more than 50% of veterans have trouble finding work. These individuals have been constrained for far too long. Tearing down biases at work is good for people and business. Together, let's create better workplaces and a better world.
Driverless cars or trips to Mars, no commission. Delivery drones or the latest phones, no commission. No matter what you trade, at Fidelity, you'll pay no commission for online U.S. equity trades.
Interactive Brokers charges 2.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 7.82% at Fidelity or Schwab to as high as 8.5 to 8.75% at Ameritrade or E-Trade. Move your account to Interactive Brokers and save at least $5,200, or much more if you're trading big bucks.
Old Dominion has ranked #1 in overall performance 10 years straight. Customers trust OD for damage-free deliveries and real-time shipment visibility. Our people never stop working toward perfection. Old Dominion, helping the world keep promises.
Hiring is challenging, especially for a pivotal role.
It definitely felt like we were looking for a needle in a haystack.
So Dylan used ZipRecruiter. He posted his job, ZipRecruiter sent it to over 100 top job sites, and then matched his job with qualified candidates.
We were very impressed with how quickly we had quality candidates apply through ZipRecruiter. It's very important that we choose the right people, and ZipRecruiter's been able to help us do that.
ZipRecruiter, the smartest way to hire. Try it for free at ZipRecruiter.com/theprofit.
It's only human to find inspiration in nature and also find answers. Our search to transform farm waste into renewable natural gas led Chevron to partner with California Bioenergy, working to provide an alternative source of power for a cleaner way forward.
Market volatility, virus fallout. How will the Fed respond after a week of colossal sell-offs? Insight ahead of the Fed meeting. Strategies before the bell. Squawk on the Street, 9 a.m. Eastern. Watch and listen live on the CNBC app.
Breaking news, we're just 90 minutes away from the opening bell on Wall Street. The futures are pinned at the lowest levels they can go. Worldwide markets stumbling as the coronavirus snakes its way through business, finance, and everyday life across the globe. Here in the United States, the Fed makes another emergency rate cut, echoes back to the financial crisis. And shut down. States and cities cancel schools. Countless events and corporations send employees home as America prepares to ride out the virus.
watching CNBC's breaking news coverage of the historic volatility that we're seeing in worldwide markets due to the spread of the coronavirus. I'm Joe Kernan, along with Andrew Ross Sorkin. We're at the NASDAQ market site in Times Square. Becky Quick is at CNBC Global Headquarters. U.S. equity futures have been locked at down limits since they resumed trading last night about 6 p.m. Those numbers are at the lowest level that they are allowed to go pre-market. So we're watching the ETFs that track the major indexes. They continue to trade. If we open down this much, it would trip a market circuit breaker. You can see the Dow's indicated down 10%. That would pause trading for 15 minutes, virtually right at the opening bell. And we saw that twice last week. Treasury yields, even after all that extraordinary Fed action that we saw, are about where they've been, at least on the 10-year. You can see we're just under 0.8% at 0.78.
Okay, this hour we've got team coverage of the fallout from the coronavirus in America, from the White House's response to the markets, to the emergency Fed move last night, to the impact on some of the most important industries in America and what it all means for your money. But we're going to begin right now with Eamon Javers. He is in Washington on the latest from the Trump administration. Eamon.
Yeah, good morning, Andrew. President Trump came to the White House briefing room last night to tell reporters that he'd been in touch with the grocery industry and major retailers around the country on a conference call yesterday. He urged Americans to stop some of that panic buying that we've been seeing as people load up on supplies for an unknown period in home quarantine or self-isolation. Here's what the president had to say yesterday.
You don't have to buy so much. Take it easy. Just relax. People are going in and they're buying more. I remember, I guess during the conversation, Doug of Walmart said that they're buying more than they buy at Christmas. Relax. We're doing great. It all will pass.
Now, here's what we're expecting on Capitol Hill today. Treasury Secretary Steven Mnuchin said they are going to have to pass a technical correction to the House bill that passed on Friday. They say they'll be doing that through the afternoon in the House. Mitch McConnell, the Senate Republican leader, said that they want to focus on the next bill in the Senate. That is expected to include some broad economic stimulus, which was not in this first bill. The Senate's back for a vote tonight on the FISA bill at as early as 5:30 this evening, and we are expecting later on this morning at about 10:30 today, a new update from the coronavirus task force at the White House. Officials not saying exactly what's on tap for that, although ultimately here, I talked to a White House official this morning who said that the announcement for 10:30 is still TBD. So a very fluid situation here in Washington, guys.
All right, Eamon, thanks. Joining us now to talk more about the Trump administration's response to the coronavirus and what's at stake for the economy. We're joined by Peter Navarro, Director of the White House Office of Trade and Manufacturing Policy.
Good morning, Joe.
How are you, Peter? Good. It's good. Thanks
for
coming on. So there's two different ways to look at it. First, let's talk about the response to the actual threat of the virus itself. Sure. Then we'll talk about trying to help the economy out.
Sure.
How do you think we are now in terms of testing with the latest initiatives that we've seen and maybe ramping up some beds and gathering together all the ventilators from all the different places we can, DOD or wherever they happen to be? What you saw last week, all the people gathered behind the president and CEOs as well. Are we on our way to being able to test to the extent that we need to?
Joe, let me tell you a little bit about what I've been doing, which I think is going to answer that question directly. As we ramp up the testing this coming week, on Friday, I got the word that we may have some issues with enough swabs, right? So the problem is, because of our globalized supply chain, a lot of them were over in Europe that needed to be here. So what I did was call up the Pentagon, and I got a unit there to dispatch a mil-air plane and got wheels up within 48 hours over the weekend. We're working hard on this. But we also had a problem where once we got the plane from Europe over to U.S. soil, then we had to get it to 4 different cities, Athens, Ohio, Cranberry, New Jersey, Coupland, California, including L.A. So what I did there is I called up the CEO of FedEx. He picked up on the first ring. I said, Fred, we got a problem. Can you give me a couple of planes to get these things to the people where we need them in Trump time? And he said, sure. He called his son, who runs logistics for him. We talked, and as we speak, we have the plane in the air. It's going to land at 2 a.m. tonight. It's going to be met by the FedEx planes, and we're going to have 1 million swabs on 59 pallets that'll go to the American people so we can get tested. And then that's going to be one of a series of flights we're going to be running over the next 10 days. So this is the kind of thing that we're doing. It's not just the full force of government, Joe, that we're throwing at this. It's the full force of the private sector. And FedEx has been instrumental in Roche. Last week, I got a call from Honeywell, said they can get up some mask production within 30 days with a little help from the government in terms of moving some paperwork through. And so on Friday night, I got them to submit their proposal. I've got assurances from HHS. They're going to flip that within a couple of days. And as we speak, Honeywell's getting ready to set up a mask factory in Smithfield, Rhode Island. So, Joe, to your point, these are the kinds of things that we're working on 24/7 here at the White House.
That's one example of what means. I mean, on Friday, two examples. On Friday, we saw that the market did rebound during that meeting with the CEOs and with the president, and with highlighting some of these efforts to get the testing done. But we're heading right back in the soup today to some extent, to giving back all of those gains. But in your view, what we heard about the ability to ramp up testing to the point where people that want to test will be able to get a test, that's going to be coming online today, tomorrow, this week, to the point where we're going to know exactly where we stand?
So I'm gonna let the task force answer that big question. What I can tell you is I'm doing everything possible, and we got a lot of people doing everything possible to make sure the supply chain's intact, that we get what we need. I mean, the big issue for me now, and I was listening to Andrew earlier, and I think what he said was right. You know, the market response is going to be dependent on the policy response. And I see, Joe, 4 points of the compass we have to hit. One of them certainly was what the Fed did. That'll help with liquidity issues. One of them is what the House did, passing that bill, and the Senate might pass, which is simply, it's a relief package, Joe. It's not a stimulus package. It's great and it's important that people in America won't have the choice of going to work sick or staying home and going broke. That is such an important policy so that we can mitigate this virus. But there's 2 other points to that compass, Joe. I was heartened by the tease you had there about how Senator McConnell wants to move now to a broad stimulus package. We know what the president wants. He wants a payroll tax cut till the end of the year. In my judgments, that's the best possible fiscal stimulus because it's simultaneously a pay raise for American workers of 7.5%. It's like an extra paycheck every 3 months. It's also is going to help our small and medium-sized businesses with their cash flow problems. And then the 4th point of that compass, Joe, is going to be targeted industry assistance for the most heavily impacted ones. And my view is that if we make those 4 policy responses and we do it in Trump time, which is to say this week in a matter of days, bring the House back, get them in session, we're going to be just fine. But this is the time where America is going to band together, and we have to work together, and we have to do things quickly. We can't fiddle around.
Peter, I agree with you, but let's talk about the last 2 pieces of that. Targeting stimulus effectively or bailouts to specific industries. We heard the Treasury Secretary over the weekend say he wants to go to Congress to ask for the ability to do that. How do you think that plays itself out? And then we can get to the other piece.
Well, I'm going to let the Treasury Secretary work with the Hill on the industry assistance portion. There's a lot of different ways that can be done. My big focus now, Andrew, is making sure that people understand how important this payroll tax cut is. If we take it to 0 through the end of the year, it's enough stimulus with everything else going on to offset the coronavirus, Wuhan virus headwinds.
Peter, what do you say to critics who say if you're not employed, you're not going to be a beneficiary of that, though?
Well, that's why we have the targeted relief. If we if we have people who are on sick leave, who get furloughed for sick or whatever, we have that particular targeted relief. There's going to be unemployment benefits. What we have to do is all of these things, Andrew. That's what I say. We have to do all. Look. This is a crisis that tries our souls. We are up to this crisis. We just need to do what's obvious on the chessboard to do. And as Mitch McConnell indicated, that's a broad stimulus in addition to the relief package, industry assistance, and what the Fed did today. And everything, we're going to get through this.
Let me ask you to respond to this. And I know that the administration is scrambling to try to get as much help as it can to this country. The New York Times reporting this morning that the administration attempted to persuade a German firm developing a possible vaccine, the company CureVac, to move its research work to the United States. This is according to German officials, raising fear apparently in Berlin that President Trump was trying to assure that any inoculation will be available first in the United States and perhaps exclusively. Can you speak to that?
What I can speak to is this broader, interesting issue of how dependent the United States of America is on the global supply chain, not just for its medicines, but for its medical supplies and medical equipment. And as we speak, I'm bringing an executive order that the president personally asked me to move quickly on this issue. And the essence of the executive order, which we hope to get to the finish line by the end of the week, is to bring all of that home so that we don't have to worry about foreign dependencies. 70% of our advanced pharmaceutical ingredients comes from abroad. We got face mask issues, goggle issues, things like that. If we get this executive order through, it basically attacks the problem in three ways consistent with what President Trump not only has been governing on, but campaigned on. It's Buy American, it's Innovate, and it's Deregulate. And the Buy American piece is important because the VA, HHS, and the Department of Defense buy a ton of medicines, medical supplies, and equipment. We need to have them buy that from American producers on American soil. And what that'll do is attract investment. We have a problem with the FDA and the EPA in terms of siting and operating facilities here in America, so we're going to deal with that. And again, what I've been doing, Andrew, Joe, Becky, it's like I'm working to get a bunch of money that Congress appropriated in emergency supplemental to flip a switch in an advanced manufacturing facility in Virginia within 30 to 45 days so we can make stuff here and do it more cost efficiently than everybody else around the world. So these are the kinds of things that this White House is moving on at full speed, and we're going to get through this, and everybody's on this.
So you've got your ears everywhere, Peter. So this is probably a Treasury Secretary Mnuchin question, but is the administration and Secretary Mnuchin satisfied with the orderliness of what's been happening in the stock market, even though we're down? Probably looks like we're going to be down 10% again today. That puts us down near 30. Are they satisfied with that? And I can't imagine that the notion of actually halting the markets has even been raised at this point. Do you know, unless it was for health reasons?
Not my lane. My charge here, Joe, I'm a soldier. I'm out on the front lines making sure we got enough swabs, masks, making sure that we're bringing our supply chain home. So that's what I'll focus on. And I want to assure Wall Street and the American people that we're tackling this. We're working 24/7, whether it's here at the White House or remote through telecommuting, but it's all hands on deck, and I've never been more proud of this administration.
Okay, good. All right, Peter Navarro.
Can I ask one real quick question?
Hey,
Peter, I know a lot of questions for particularly small businesses in this area where things are really starting to shut down, in Seattle too, I'd imagine. What happens for the restaurants, the bar owners? What kind of relief can they expect to be getting when they're told that they're going to have to shutter, at least for the foreseeable future?
Well, I think that's where the relief package that the Hill's debating on. Again, what I'm concerned about, my lane here is the broad fiscal stimulus. I can't stress that more. There's going to be people not working but the majority of people will be working. That's where that broad stimulus comes in, and we help people that aren't. That's the whole thrust of this. 4 points of the compass. We got to hit this from every kind of angle, and we've got everybody working on that, Becky.
Thanks, Peter.
All right, Peter, thank you. Appreciate it.
Pleasure.
And keep working.
I'm working.
All right, thanks.
All right, as we've been telling you, the futures are pinned at the lowest level that they're allowed to go before the opening bell. We're also paying close attention to the ETFs that track the major indexes because that gives you a better indication of what market sentiment really is. Fair value down 5% for all the futures contracts. If you're looking at the Dow ETF, though, it's down by more than 10% right now. S&P futures down by 9.75%. And remember, at the opening bell, there are additional circuit breakers that would kick in opening trading. If you do see the major averages down by 7%, that would force a 15-minute halt in trading. The next halt would come at 13% down. So these are numbers we'll be watching very closely today. Joining us right now to talk more about what's going on, Steve Leisman, Mike Santoli, and on the newsline, Anastasia Amorosa, who is head of cross-asset thematic strategy at JP Morgan Private Bank. We also have Greg Ebb, who's chief economics commentator at the Wall Street Journal. And Mike, why don't we start with you just to talk about some of these market moves, what we're seeing right now and what that could indicate as we get closer to the opening bell.
Yeah, obviously, I mean, the market would... Sorry,
I've got you. I've got you, Mike.
Okay. What's essentially going on is the market is sort of placing everything in the too hard pile. It always rushes to price in the future. Right now, what we're pricing in is a indefinite, intentional overreaction in the economy. What I see in terms of levels kind of doesn't matter in the indexes. It really is a very much an indiscriminate liquidation type move. We're going to get to further extremes. Last Thursday, you only could compare it to periods in 87 and 2008. Now we're going to have something more consequential in terms of the intensity of this downdraft in a short period of time. I'm really much more focused, though, on non-equity issues like the credit markets, like how they trade, whether we see signs of stress building or stress easing after what the Fed did last night, because that really would be the exacerbating factor beyond simply, the market basically deciding it cannot handicap what's going on in the near term in the economy.
Steve Leisman, I know you've been looking at that, too. What have you seen so far? What have you heard back from the calls you've been making?
Okay, I've been on the phone most of the morning with different people and over the internet as well, tweeting and stuff with people who are in the markets. Everybody says, Becky, it's too soon to tell. There's two basic themes. One is this is not something that the market is going to reprice on the come, essentially waiting for the Fed, expecting the Fed to act. They're going to wait to see how the actual actions by the Federal Reserve have an impact on the market. So the timetable here is the Fed is probably in the market doing repo right now. There are a series of purchases where it's going to buy $40 billion of treasuries, and I think MBS today, there may just be treasuries throughout the day. And if it's going to have an impact or a positive impact, that's where it's going to be. That's on the one hand. On the other hand, I'm hearing people talk about what the Fed is not doing and that the commercial paper market is not trading well at all. And you'll notice yesterday or last night, the Federal Reserve said nothing about commercial paper. And that's where I'm hearing a lot of discussion that the Fed has to come in and be a buyer here. For that, I believe it's going to need the Treasury backstop.
Greg Ebb, let's talk to what you're thinking about this, the actions you've seen from the Fed and what you're hearing about the market potential problems at this point.
Well, I think what the market is basically telling you is that they know that the Fed is out of bullets, at least of traditional monetary bullets. I mean, the market responded very badly to the first half-point rate cut. They've responded badly to this full percentage point rate cut, and that's not the fault of the Fed. It's basically the Fed has used up whatever conventional ammunition it has, and it's not even clear that that ammunition wasn't well calibrated to the type of problem we're having here. That said, I think what the Fed has done in terms of the liquidity stuff and the promise to be the buyer of last resort on Treasury and MBS will keep things from getting worse. It's basically the Fed's traditional lender of last resort function. It's going to keep the economic crisis from becoming a financial crisis. But like Steve said, I think we're going to have to see how the markets actually behave and the way the Fed actually implements this plan to see just how quickly it's going to have the desired effect.
Hey, go ahead, Becky.
No, go ahead.
I was just going to ask Greg, you covered the financial crisis, and we've been talking all about the measures that the Fed has been taking and may be able to take in the future. But one of the things we just talked to Peter Navarro about, and clearly one of the issues that is cropping up, given that Stephen Mnuchin is talking about bailout powers, is what you think the Treasury may ultimately need to do when it comes to both industry, big industry potentially, and also small businesses, to the extent that there's an opportunity to provide a bridge loan, which might be a very complicated thing to do, but conceptually is what may be necessary.
Well, I think there's a lot they can do, but they're going to have to make a tough decision on how they help two different classes of companies. Those that are just illiquid, they're solid businesses, but they have a 1 to 2 month cash flow problem. That's where things like the Fed's commercial paper facility can come in. They're just overcoming the reluctance of the market to provide funding. The bigger problem is companies that are potentially insolvent. Their business is going down because they're essentially getting no revenue for the foreseeable future. That's a much tougher call. The model you want to look for there is the airline bailout that we had after 9/11. Congress passed $5 billion in cash assistance and $10 billion in loan guarantees, which are administered through a board that included the Fed chairman. So I don't know exactly what they'll come up with, but there needs to be a sort of a mechanism that makes that distinction. One of the problems you're dealing with is those things take time to get in place. The Fed can probably move relatively quickly to create something like the commercial paper facility, but establishing these sort of like bailout mechanism is going to be tough, and there's going to be a lot of criticism and second guessing about whether you're throwing good money after bad and whether you're bailing out Wall Street and corporate America instead of the working family.
Anastasia, what are you thinking this morning?
Well, absolutely spot on what Greg has said, is that the missing piece of the puzzle here is the fiscal response and providing assistance, maybe with some credit facilities to the businesses that are going to be impacted by the containment measures. But the reality is it's going to take time, and maybe it's a few days, maybe it's a few weeks, but it's going to be some negotiation to get there. So from a market perspective, the action that we're seeing today and we've been seeing, we could see more of those plus or minus 5% or even 10% down days, because it's going to take time for the policymakers to come up with the adequate response. Having said that, I think they will ultimately get there, and the testing helps. The Fed stimulus package absolutely helps, but we really need to see something closer to a $500 billion overall fiscal package from the federal government to really provide the offset to this economy. It needs to be sweeping, and it needs to be comprehensive, and thus far we've not seen it yet. So definitely some patience will be required in the markets in the meantime.
Hey, Steve, again, this is moving pretty quickly. We're not talking day by day. We're talking hour by hour, and maybe more quickly than that. What should we be watching as we get closer to the opening bell? What are you hearing back from all of these market participants you're talking to?
I think we have to see how some of these spreads trade. I will say there's some consternation about the Bank of Japan. Some of the Japanese banks, it's my understanding, have withdrawn from some of the dollar funding markets. And they were hoping for better guidance from the BOJ to urge banks to use the dollar swap lines. That did not come, so there's concern in that regard. We're going to have to watch how commercial paper trades. We're going to have to watch how the different treasuries trade versus derivatives and versus the on the run and the off the run. I will say one thing. I don't want to be too optimistic here, but Andrew and I have been having sort of a running discussion about the difference between what's happening now versus the financial crisis. As far as I can tell at this point, it may be one very good sign here that we do not have bank solvency problems. That was a huge issue in the financial crisis. And as far as we know, the banks are well capitalized. Indeed, one of the issues out there right now is the Federal Reserve trying to get the banks to use what liquidity and capital they have. It was a very interesting statement last night that the Fed put out, which basically said, as you get closer to your liquidity coverage ratios, we are not going to penalize you. Banks are very concerned because of the Dodd-Frank and the liquidity ratios that were put in place, that if they get close to those ratios, that they'll be penalized by the Fed. There is capacity out there on the part of the banks, because there are not solvency issues, to help this problem, and we'll see if the Fed is effective in getting the banks to step up.
Steve, I think you're right, but I would also just raise to you, and one of the things that happened in Dodd-Frank, I don't know if you remember, was the big battle over something called HQLA, which was high-quality liquid assets necessary so that if every bank, so that if every client effectively called their bank and said that they wanted to draw down their lines, that they would have those lines available for 30 days. The test in this instance, given the demand issue, given the social distancing that may very well be required to minimize the spread of the coronavirus, is what happens after 30 days. And that's the hard part to figure out. And I question from
Andrew,
a policy,
can I give you...
I question from a policy perspective whether what they need to do, especially in terms of giving confidence to the market and to those banks, whether they can actually extend that out.
Right. There's a variety of different things the Federal Reserve can do to give banks a little more comfort to step up. Right. And I'm going to give you one right now that I suggested last night to a top investment banker, and he says it was a great bleeping idea. Cancel the upcoming stress tests. Why? Because the banks are being tested right now under stress. What would be the point of doing an actual stress test? This could also potentially free up some firepower on the part of the banks. Other issues out there would be to lower some of these liquidity coverage ratios and reduce them. The Fed did not do that last night.
Those are good
That is
ideas.
another potential tool in the Fed's arsenal.
Those are good ideas. Greg, what do you think about it?
Yeah, I think that any sort of comfort the Fed can give the banks that they're not going to essentially come down like a hammer if there are marginal breaches of some of those ratios would be helpful. But here's the thing I kind of worry about, which is that after the TARP, after all the measures the Fed took to help out the banking system and basically save us from a second Great Depression, there was just a nasty years-long political backlash. Even last week we saw some people on the left saying that if the Fed's going to lend $1.5 trillion to Wall Street, then surely there's $2 trillion for Medicare for all. If you're a banker, you're worrying a lot that any sort of effort to comply with the Fed's pleas that they lend more and accept this concessionary funding, they're asking on the back end, do I get crucified in Congress for this?
Well, I think the answer is yes, and there's no way to protect them from it. They've been through this, they've lived it, they tried to do the right thing last time around, and a lot of them did get that.
Exactly, and I do worry about that. We're going to pay the price for that lingering reluctance to risk the stigma of being a beneficiary of Fed largesse in this.
Greg, but don't you think this is going to be considered? I mean, we've said it before. This is being considered, I think, a natural disaster with many man-made mistakes along the way, as opposed to a man-made mistake, which was the 2008 crisis.
Yeah, that's a good point. And I think that's an important distinction. I would say though, if you're a banker, and I haven't spoken to enough to have a good feel for this, is that the question you're asking yourself is, well, is the problem that my customers are just illiquid? This goes back to my other point. Are they just illiquid and need a temporary help, or are they actually going down? And so I think your typical banker is making a very tough decision now. I can go to the Fed and borrow some cash to help out this customer, but is the customer actually money good in 2 months from now?
But that depends on the fiscal stimulus, too, what kind of relief we offer to them.
Right. So then you get back to the point that I think that there are other parts of the government, not the Fed, but other parts of the government that can actually help potential insolvent firms, that can actually pump extra cash into the economy to give some degree of comfort and confidence to both bankers and their customers at the end of the shutdowns and the social distancing, that they will have viable businesses and that there will be demand from customers.
All right, Steve, Anastasia, Greg, Mike, want to thank you all, and we'll be checking with each of you again soon.
And if you are just waking up, the futures are pinned at their lowest possible level that they could trade since about 6 p.m. last night. Because of that, we're watching the ETFs, as we do. Closely track the major indexes. We can get a better idea of the damage this morning. Down 10% now, indicated. If suddenly the futures were able to trade where they wanted to, that's where the Dow would be. Take a look at how some of the biggest Dow components are trading in the pre-market. J.P. Morgan down about 13%. Take a look. You saw Boeing. There's J.P. Morgan. Sorry, and then Apple and Microsoft. Some significant double-digit losses. Just point out that we did, it was a volatile week last week, terrible day on Thursday, but on Friday we got back some of that 2,300-point loss. We got back almost 2,000 points. Now we're giving back, looks like about 10% this morning so far.
Okay. Meanwhile, some of the workers that could be hit hardest by the coronavirus crisis are the gig economy workers. And yesterday, Uber announced new policies aimed at helping its drivers. Those include providing financial assistance to drivers for up to 2 weeks if they're diagnosed with COVID-19 or are personally placed in quarantine by public health officials. And earlier today, Uber Eats announcing measures to help restaurants that use its delivery service. Joining us now to talk all about this and more, Uber's Chief Financial Officer, Nelson Chai. Good morning to you, Nelson. Thank you for joining us this morning. Just tell us, anecdotally or statistically, given that you have the data and the numbers, what the fall off in drives and businesses looked like even over the past couple of days?
Well, so first of all, Andrew, the most important thing for our company right now is to make sure that we are working with the local health authorities to help flatten the curve. So we have a team that is in constant contact with the local authorities. We are following their lead, and we're doing a number of different things from our half in order to try to help flatten this curve. Some of the things we're doing is, as you know, they want people to work from home, so we've initiated that at our company. We are, as you mentioned, trying to help our drivers, and so we did announce that we will be helping compensate drivers for 14 days if they are quarantined or affected by the coronavirus. We are making sure that we pass on to our drivers all the information that we receive from the health authorities. We are working on disinfectant as well for the drivers to help them feel safer in their cars. And as you mentioned this morning with Uber Eats, what we're doing is we're actually eliminating the delivery fees in many of our markets for independent local restaurants. Additionally, what we're going to announce this morning is that we're going to deliver over 300,000 free meals to health officials and first responders who are on the lines helping on this business. And so we're doing what we can. In terms of our business, we're everything this morning you've been talking about with your guests talks about liquidity and the financial crisis, and as you know, I have some experience there. We've done a very good job at Uber in terms of making sure we have ample liquidity to make sure we can get through this crisis. We have over $10 billion of cash on our balance sheet. The long-term debt we have has no liquidity triggers or covenants. Our first maturity is in 2023. And while we do have a revolver, we don't plan on actually accessing any of it. As you can imagine, because of my experience, we are doing a fair amount of stress testing, and we believe we have ample liquidity to make sure that we can make it through. As you know, and as your guests are talking about, during these times, it's actually not about profits and losses, it's about liquidity. And so it is important that companies have ample liquidity on their balance sheet in order to make it through the crisis.
Nelson, let me ask you this. I'm actually less worried right now about the liquidity of Uber. I think the company itself will get through this. The question is, so many of these gig workers are effectively their own small business, and demand is falling off a cliff, and for good reason. And in many ways, from a health perspective, you may want demand to fall off a cliff. The question is what you think from perhaps a policy perspective or from a corporate perspective can and should be done for those drivers, and therefore, by the way, long-term for the economy and then the demand picture on the other end.
Sure. So first of all, for the drivers, in this country today, if you're an employee, you get benefits. But if you're a contractor, you don't. So we actually think there's a third and a better path. So today in the UK and France, we actually are able to provide our drivers with benefits, including health insurance. If you look at our ballot initiative, Andrew, one of the things we're promoting, besides minimum driver earnings, is also benefits. So we actually think there are ways that we can, in the private sector, help address this. And so we are certainly on the forefront in terms of making sure that our earners actually have benefits.
What keeps you from offering benefits in the United States?
There are actually laws that we're working through, Becky. And so today in the UK and France, we do.
But what are the laws that are preventing you from offering benefits to your employees or contractors?
Well, so to employees you can, to contractors you can't.
But Nelson, in truth, you've been fighting the contractor issue in California and throughout the country.
Because you don't want to say that they're employees.
Well, they're not employees, and actually most of our drivers today actually drive part-time. Only about 10% of our drivers in the U.S. drive what you consider full-time. And what they'd like to do is they like the flexibility on our system, and they've told us this. Right. But what they would like are some benefits, and so to the extent we can get the rules changed, we would be happy to work with the authorities.
Starbucks offers benefits to its part-time employees?
They're employees, Becky. And then, Andrew, your second question was really about global demand. And so what I would tell you is this. So as you know, we are a large global company. We're diversified. What we've seen to date is our Uber Eats business is about 25% of our gross bookings today. That business continues to manage through the crisis. On the ride side of the business, we are starting to see over probably the past week and a half more impact in certain key cities, particularly as the crisis has spread towards Western Europe and in the United States. So in a city like Seattle, where most of the residents now are working from home and they are curtailing, going out, you are seeing some significant impact in the 40 to 50%, in terms of what we're seeing today. But again, this has been over the past week and a half or so that we're starting to see these statistics. Similarly, in Latin America, we're actually not seeing as much impact today. We do expect over time that it'll be a city-by-city thing. The one thing about our business is we do see some recovery. So in Hong Kong, as you know, that was dealing with this virus earlier, peak to trough, we saw rides decline about 45%, and that was in the last week of January. We're starting to see those rides come back. Our Uber Eats business has actually done better than we had anticipated. And so we do expect that this will have impact. Our primary concern today, though, is really about doing what we can do to help the local health authorities manage the containment.
Just final question, because the Hong Kong experience is perhaps the model we should all think about. You're saying it went down, just so we're clear, down to 40 to 50% down, and is now where? In terms of the return?
I would say it's probably come back. So again, peak to trough, the maximum was 45. It's still probably about 30% off, I would say, today. But we're starting to see a steady decline. And as you know, the cases in Hong Kong have actually flattened out.
Right.
And we do expect in our business, as you know, we are a largely variable cost business. We do not have large CapEx expenditures. We do not pay for slotting fees. We don't have cars that run empty. And so what I would tell you is that we do believe our business can recover when we know that we're an important part of how people get around, including you, Andrew, as we know.
Yes, as you know.
And so when people start going back to work, we know that our recovery should be aligned with people going back and moving around in the city.
Right. Okay. Nelson, we really appreciate you joining us to help us through this. You also lived through the financial crisis, and we look forward to talking to you again soon.
That sounds great, Andrew. Thanks.
Overnight, we got numbers out of China, their first look at what's been happening with their economy. Retail sales were down by 20%. You're looking at record low consumption numbers. And now we just got a terrible print on the latest Empire State manufacturing data here in the United States. Rick Stantelli is standing by in Chicago. And Rick, walk us through it.
Well, obviously, it's an old number in so many ways. We all know that. But minus 21.5 is the worst level in 11 years for Empire, which takes you back to maybe minus 33.7 in March of 09. And there's only one number worse. That was the previous month, which is the all-time 20-year low in that series of minus 34. So we have our GPS. But the issue of whether we're looking at Chinese data or ultimately Japanese data or German data or any of the car data, we know it's going to be impaired, and it's going to be impaired in a big way. We've seen what the Fed is trying to do. We've seen coordination with other central banks. The Bank of Japan and the ECB did not lower rates, which I find interesting and I think hopeful in certain ways. As for how this is all going to affect the markets, consider this. Right now, our yield's 34 in a 2-year note. The low intraday for all maturities was 1 week ago on the 9th, which was 24 for a 2-year. It was 31 for a 10-year. It was 69 for a 30-year. We need to keep these in mind because we really can't garner much information. The curve's flattening a little bit. We're down a few basis points more on a 10-year than we are on the 15 or 16 basis points we're on down on a 2-year. But in the end, whether the Fed is going to buy, whether they're going to tweak, keeping the gears going is the only thing that matters. I can't really tell you much about rates. It's not a financial crisis. It's no money coming in. How are companies going to last, and how will they differentiate between the zombies that shouldn't get money and the ones that really need it? There's some complicated questions there. Becky, back to you.
Rick, what are you hearing about the stresses on the market, on the Treasury market today?
You know, I think the stresses are going to be around. It's impossible for them not to be, but I don't think that the stresses are beyond any expectations for many who've been observing these markets for many decades. The Fed has 2 big cans of grease for the gears, probably more than we need. The whole notion of quantitative easing, there's going to be plenty of buyers. It's just that there's not plenty of buyers and sellers at every given moment, and I think the Fed is there to address those in the big picture.
All right, Rick, thank you. We'll check in with you again soon. Major U.S. airlines are taking some pretty drastic steps to try and confront a sharp drop-off in demand and new travel restrictions, all because of the spread of the coronavirus. Phil LeBeau joins us right now with more. And Phil, again, this is a quick changing story this morning.
Yeah, and Becky, we'll talk about the U.S. airlines in just a bit, but we just seen some wire flashes regarding Virgin Atlantic. To give you some sense of how airlines around the world are reacting, Virgin Atlantic, 8 weeks of leave the staff are going to be asked to take over the next 3 months. It's also going to be grounding 80% of its flights. That's just a taste of what we're hearing from all airlines around the world. Here in the U.S., let's start first off with the news regarding United Airlines. Last night, the company announced that it's going to be cutting 50% or its capacity by 50%. United CEO saying demand is getting worse. Stifel downgrading United to a hold. Let's move on to Delta. Remember last week they said they were going to cut capacity by 40%. They're already, because of the travel restrictions with the UK and Ireland, we're seeing some of the flights, whether it's from JFK, whether it's from Detroit, other hubs, they're going to be cutting those back, eliminating them, at least for the time being. And then you have American cutting its international capacity by 75%. It was downgraded to neutral today by Goldman. Finally, Ryanair, another taste of what we're seeing with airlines, especially over in Europe. CEO Michael O'Leary saying that the majority of the fleet will be grounded over the next week. Guys, a lot of this in Europe with these airlines is because countries are saying no flights from outside. Whether it's Poland, whether it's the Ukraine, etc., a number of these countries are saying we just don't want any flights coming in. And that's why you're seeing the European airlines reacting the way they are with grounding their fleets. Here in the U.S., the focus is what does D.C. do, A, to help the airlines, B, are there further travel restrictions? That's what we're going to be watching today.
Virgin Airlines, that 8 weeks of leave that they're asking staff to take, is that paid or unpaid?
Virgin, a little unclear, Becky. It's unpaid is what I'm being told. Unpaid. So this is what we're seeing. And you mentioned earlier about American's pilots working out a new agreement with the management there. You're going to see this increasingly happen with the unions and all of the carriers working out new agreements in terms of what happens with either pay cuts, furloughs, etc., because they all have to do this. The airlines are now in a cash conservation mode, and they have to work out something with their unions, at least in the near term.
All right, Phil, thank you. We'll see you again very soon. The number of coronavirus cases in the United States has officially topped 3,700 with 69 deaths. As government officials close schools and mandate closures of bars and restaurants, the Centers for Disease Control is recommending the cancellation of all in-person events of 50 or more people for the next 2 months. That means everything from sporting events and festivals to weddings and beyond. Joining us right now is Dr. Scott Gottlieb. He is the former FDA commissioner. He's also a CNBC contributor, and he serves on the boards of both Illumina and Pfizer. Scott, you've been kind of guiding us through this almost every day. Where do you think we stand right now?
Well, I think right now, we're about 6 weeks. We're about 2 weeks into the process where between when China first identified community spread and then you had the lockdown of Wuhan. I think the difference for us is that we identified our community spread much earlier than China, and I think we're starting to take mitigation steps much sooner than they did. China did just about everything wrong during those 6 weeks. I think we're doing a lot of things right currently, notwithstanding the challenges we had getting the diagnostic tests deployed, which will be fully deployed, I think, this week. I think by the end of the week there's going to be much more diagnostic screening. I think the steps that the governors are taking right now, which are very aggressive, are going to absolutely impact the trajectory of this epidemic. I think we need to continue to do that. We need to have a difficult March so that when we get into April, this peaks out at some point in April. And if you talk to some of the folks who are modeling this, there is a sense that this is likely to peak sometime in mid to late April, and heading into May we'll be coming down the epidemic curve. And the goal right now is to keep the infection rate as low as possible at any one point in time so we don't exhaust the healthcare system, so we don't start having more deaths as a result of the coronavirus.
I think we need to emphasize what you just said. You expect this to peak in late April to mid-May. I mean, that's longer than probably a lot of people in the American public are expecting at this point. Lots of us are being told our schools are closed for 2 weeks. That doesn't sound like a realistic goal if what you're saying is right.
Well, I think the schools are going to end up closing for longer periods of time. I think they're announcing 2 weeks at a time, and they'll reevaluate the situation. In certain districts where there might not be community spread or evidence of community transmission, schools might make a decision to restart, although I think it's unlikely. But that's a good case scenario. This is going to be a 6 to 10 week process, and I think if we can get through this in 6 to 8 weeks, and keep the peak of the epidemic below the point at which the healthcare system gets exhausted. If you look at what happened in South Korea, Italy, China, that was about the length of time that it took the epidemics to run the course. South Korea is much more successful at keeping the peak number of infections down. Italy is obviously losing control of their infections right now and of their epidemic. I think what we need to do is focus on how do we blunt the impact of the mitigation steps that we need to take to try to reduce the community transmission. Things like closing schools, closing restaurants, closing bars, places where people go. So you basically slow down activity and people self-quarantine because they have no place to go.
Doctor, though, what you're saying, and this is what we've been trying to raise the issue of all morning, CEOs across the country are trying to put some timetable on this and looking at their balance sheet, trying to figure out what their run rate's going to look like. Can they withstand this, whether you're a small business or you're a big business? It sounds like you're effectively saying this is at minimum a 2-month situation, and when you really think about it, potentially 3.
Well, look, with
in terms of the social distancing that you're talking about.
Yeah, it's March 16th right now. I think if we continue to be very aggressive like we're doing right now, and we mitigate, a very severe epidemic, and we don't seed multiple cities where we have simultaneous epidemics that are large in multiple cities. Seattle and New York look pretty well seeded right now. I think by mid-April we're starting to see this maybe peak out towards the end of April. That's what the modeling shows.
Doctor, you sound better today. You said we need to do more things. We're not doing it yet. You sound like some of the stuff that's happened in the last 3 or 4 days has gotten you to the point where you think that we're doing more than we were and getting close to
I think that's right, but we can't take our foot off the brake.
Good.
Would you shut down domestic air travel?
No, but I would pull the volume out of the system. I mean, I would stop government employees, federal and state, from traveling. If you pull enough volume out of the system, you're effectively shutting down travel, but leaving it for people who absolutely must travel. You don't want to deny people their liberty, and travel is a form of liberty in this country. But I think we need to keep our foot on the gas here and not pull back. I think the governors are doing the right thing. They're taking very strong action. I would just say, if I can, we need to focus on trying to blunt the impact of this on people. Congress needs to do something to help get relief to lower income middle class workers who are out of paychecks right now. Individually, we also need to think about vulnerable Americans, older people who now are home without services, and how we can support them, because that's where the real vulnerability is. That's where you could see really adverse outcomes. And so we all need to think about what we can do to blunt some of the impact of the mitigation steps that are necessary.
Doctor, real quick, there are emails going around among investors all weekend also about this idea that there's a cure in the form of chloroquine phosphate mixed with zinc. Some people are saying it's misleading, some people are not. Can you speak to that? There's a malaria drug that apparently has or is not being used in South Korea and potentially Italy, but there's a huge investment class, including some very bold-faced names, that have been looking into this.
Yeah, chloroquine, it showed in vitro activity in test tubes. It needs to be studied clinically. I wouldn't put too much confidence in it based on the data that we have right now. But just to pick up on the point that I was talking about with Becky, what this looks like, I think, in a good case scenario, we managed to keep the scope of the epidemic contained. It peaks out some point in late April. Heading into May, we're really coming down. July and August are relatively clear. Summer camps get canceled, but it's relatively clear. Then we're back in the fall, and there's outbreaks, but we're going to have hopefully a different toolbox in the fall to deal with that. Point-of-care diagnostics, hopefully, maybe an antibody-based prophylaxis for people who are vulnerable, like the product Regeneron's working on and some other companies. So we could have a very different toolbox in the fall that helps mitigate the impact of outbreaks if and when they occur.
Dr. Gottlieb, you said earlier that New York City and Seattle you think are well-seated, not well-situated. What does that mean?
Well, well-seated meaning that there's a lot of infection probably already in those cities, and we're going to have outbreaks in those cities, hopefully not of a proportion that you saw in Wuhan and the Hubei province, but fairly sizable outbreaks at this point. And I think that's why you're seeing those cities be so aggressive. I mean, New York has been far more aggressive, and New York State's been far more aggressive than, frankly, Seattle has been. I think Cuomo is doing an admirable job leaning into this. Those steps are going to have an impact. We're earlier than the Chinese were in discovering our community transmission, and we're taking aggressive steps earlier than them too. Now, that said, we have limitations. We can't lock down a city, or we shouldn't be locking down a city. But the good news is that we're taking aggressive steps, mitigation steps earlier, and I'm not so sure that these mass quarantines and lockdowns are actually that effective.
Very quickly, areas that have not been as hard hit as New York City and Seattle to this point, should they be doing social distancing there too?
Absolutely, because they want to prevent more widespread propagation in their cities. I think if you look at states like Ohio, Maryland, New York, where the governors are being very aggressive, I think it's going to have a real impact. There's other states where there seems to be some sustained community transmission that haven't been as aggressive yet, like New Jersey. I think they're a little further behind, but I'm pretty hopeful that all the governors are going to catch up and be working off the same playbook pretty soon.
Dr. Gottlieb, great talking to you. Thank you, and we'll talk to you again soon.
Thanks a lot.
All right, some of America's biggest banks announcing they're suspending stock buybacks through the second quarter due to the coronavirus outbreak. CNBC's Wilfred Frost joins us now on the phone. Hi, Wilfred.
Hi, Joe. Yes, indeed. The 8 U.S. globally systemically important banks, that's JP Morgan, Bank of America, Wells Fargo, Citi, Goldman Sachs, Morgan Stanley, State Street, and BNY Mellon, took the unprecedented step of all suspending buybacks for Q1 and Q2 together. Also unique was that it was announced via the Financial Services Forum, of which they are the 8 members. The U.S. Bancorp also took the same action. Others may now follow. The main reason for this is the banks want to make clear they aim to be part of the solution this time, not the problem. Continuing buybacks risks painting the wrong image. They all maintain, though, that they did not need to take this action, that they have plenty of liquidity, and indeed the Fed's actions in the last few weeks have made that even more certain, the discount window decision in particular. This did not stem from the White House meeting with bank CEOs last week, but rather the last 48 hours it became clear to the banks that the Fed was going to act in a large way last night. And this was the bank's sort of show of good faith, if you will, to the Fed, rather than the Fed demanding they took this action. Now, bearish bank investors may ask why this collective approach and why via the Financial Services Forum, and ask whether there's a weak member of the group that needed to be protected. The messaging, though, from all the banks and indeed the data, absolutely the opposite. They have plenty of liquidity. Regardless, removing these buybacks will hurt earnings per share. It will remove a potential hurdle for would-be short sellers of the bank stocks. And, of course, rates are collapsing again today, so we're expecting a sharply negative open for the bank stocks. Guys?
Thank you for that, Wilf. Meantime, I want to get over to Jim Cramer. He is back at CNBC headquarters to get his thoughts on this morning and the conversation we've all been having. Jim.
Yeah, I mean, I just got off the phone with Secretary Mnuchin, and I would tell you that they're uniquely understanding of the situation. That my judgment as someone who's been on Wall Street for a long time is that they see most of the pitfalls that we've seen before, that they're not worried about the banking system after what Fed chief did, that they actually thought the Fed chief had gotten ahead of the issues. They're uniquely focused on, obviously, the working person, much less on what big industry is going to do, because they're concerned about people having food on the table. I think that's something that when you focus on the working person, you're less focused on the notion of the abstract concept of the recession itself.
Jim,
and what that means.
What kind of programs do you think we're going to be seeing over the next several days then?
Targeted fiscal programs, I believe, targeted toward working people. I think they can get that through Congress. I don't think that they're unaware of the issues involving the banking system and the common stocks. I mean, obviously, common stocks, their view is that there's going to be opportunity. They're not putting a time frame on it, which I think is wise. But reminding people that eventually this will run its course. When I say eventually run its course, I mean it's a Dr. Fauci situation. It's not their own view. They're not epidemiologists there, and they're not sanguine. Obviously, they are at the ready. But I would just emphasize these guys really understand what happened in 2007 and 2009, and it's not just that they're using that paradigm and then someone comes back and says, "Well, Jim, it's far more serious than that." I'm just saying that they understand the mechanics.
Jim.
Yes.
I want to read you, Ray Dalio is coming out with a note, which I think is going to be distributed very shortly. Sure. He, by the way, I should mention, his fund got hammered about 20% down. He said he made some mistakes in terms of not being risk off. But he says, quote, "I'm seriously concerned by what I see, which is that a number of companies and industries will have debt problems that will likely lead to restructurings. Perhaps it's to be expected that these companies will keep operating through the bankruptcy process, though this could be debilitating and would have undesirable knock-on effects because monetary policy will be ineffective and the political fragmentation will be large and potentially volatile." Do you think that this administration is going to be able to mitigate what he's talking about?
Well, look, I don't think any administration, the federal government's big enough to do some things and not other things. Ray Dalio's view, I think, is one that has to be respected. But I also point out, I mean, look, I can tell you the commercial paper market is not ready for this. I could say that the mutual funds aren't ready for this. I don't know how helpful that is. I think that people are trying to get up to speed as fast as possible. I think that the Treasury market is going to be working because of what the Fed said. I just want to caution people. I don't see a lot of opportunities, but I also think that the notion that there's going to be a wholesale destruction of the capitalist system, or that, and then I'm sure anyone can be nuanced about it and say, well, that is not what Ray Dalio said. But what I'm saying is that if we want to think about the idea that there's going to be a wholesale destruction of many companies and their balance sheets, I think that that's probably extreme, because I know that they're trying to figure out what to target. I know that their hope is to keep it so that they keep people stay on the payroll. It's not to bail out McDonald's. It might be to be able to say, listen, we're going to help the franchisees where the actual push comes to shove. The idea of focusing on the actual stock market, I think, is a little abstract, other than to say that there are a lot of companies that have a lot of good credit. I think what they took off the table this weekend was the bank runs, which I think, given what we know from 2007, 2008, were what the Fed was not aware about, and the Treasury Secretary was trying to do something, but they kept coming up with reasons why they couldn't do things. This is not what I'm hearing. They're not coming up with reasons why they couldn't do things. I think that they're flexible, and I think that they'll be able to come up with a plan. Again, I mean, Ray Dalio's view is Ray Dalio's view. David Tepper's view is David Tepper's view, that there are situations that are interesting, but obviously there's going to be destruction. What I'm trying to do is be, I guess, words like destruction I just don't think help. I think there'll be companies that, like the cruise industry, which are clearly hobbled. I don't know why the banks should necessarily be hobbled if they're going to be able to get through this. It's almost as if what David Faber tweeted this early this morning, which was, if you could look further, I mean, they're not considered about holiday. They're just, the Treasury Secretary is not going there. Right. But if you look a little further out than this very moment, maybe Buffett-like, as Becky knows, then I think that you'd be saying, you know what, there may be destruction, but there may be opportunity.
All right, we're going to check back in with Al-Arian quickly. Jim, thank you. We'll be watching at 9. Allianz advisor, chief economic advisor, Mohammed Al-Arian. So, Mohammed, we're going to be down today. Looks like at the open, over 10%. So that brings us back down to the lower end of what you initially talked about, a 20 to 30% soft. You said at 30 you would reevaluate. Are you reevaluating, and what are you coming up with?
I'm coming up with at least 35% fall from the highs. So we have more to come down here, even after you reflect what's in futures. But I can tell you one thing, is that there are very selective opportunities because we're seeing indiscriminate selling. Right. Understand that the private sector is front-running a lot of this stuff. The good news is on the health issue. The private sector is social distancing much faster. The bad news is people run on grocery stores, and people are now taking their money out in a big way.
But I could see it fall more, but then the question is, you also don't want to be caught out when and if you believe that Steven Mnuchin or others in the administration are going to inject some kind of massive policy into this.
Yes, absolutely, but respect the technicals. I can't stress that enough. And remember, when people cannot sell what they want to sell, as I said earlier, they'll sell whatever they want to sell. So this is going to be very indiscriminate. That's where the opportunity comes from, but it comes from relative value at this stage. Outright longs will come later on.
Okay. As far as you had 3 or 4 different things you're watching, the Fed, the action there. You think that the disorderliness in the fixed income market or in the cash, the money markets, you figure that's not as worrisome as it was for you now? They got that under control, so that takes away one of the risks you were worried about, doesn't it?
Yeah, I'm not worried about the payments and settlement system, and I'm not really worried about U.S. banks. But what people have to understand is this is a fundamental shock. The economy contaminates finance. Finance will reverse contaminate the economy. And when we emerge from this, we are going to see a very different landscape. And I'll talk with you about this later. For credit risk, equity risk, interest rate risk, and liquidity risk, we are going to turn upside down long-standing assumptions that got us where we are today. So the landscape, when we emerge from this, will be very different, Joe.
All right, thanks. Sorry, a couple times today, Mohammed. We appreciate it. We'll be back again tomorrow to do this all over again. CNBC special coverage. See you back continues right now.
Good Monday morning. Welcome to CNBC Special Coverage, Markets in Turmoil. I'm Carl Quintanilla at the New York Stock Exchange. Kramer's at CNBC Global Headquarters. Faber has the morning off. Markets trying to price in this historic cessation of economic activity all around the world and the emergency steps by the Fed and other central banks. Futures limit down. Europe down 7 to 10. Crude oil south of 28. As you know by now, the Fed slashing rates, announcing $700 billion in asset purchases to aid the economy. Last night, Chair Powell held an emergency news conference, says he does expect a rough second quarter.
The second quarter is probably going to be weak. In fact, in the view of many, output declining, output lower in the second quarter than it was in the first quarter. After that, it's very hard to say how big the effects will be or how long they will last. And that's going to depend, of course, on how widely the virus spreads, which is something that is highly uncertain and I would say, in fact, unknowable.
All right, Jim. So it's just you and me today. Let's start broad. Let's just get your thoughts on the last 72 hours. What are you thinking right now?
Well, I think that the one thing that I was very worried about in the 2007-2009 issue was, could I take out $50,000 from J.P. Morgan Bank? Because I was concerned, and I took it out. I took money out of a lot of different bank accounts. This time I'm not. This time, what was the purpose of last night? There's a lot of minutia, and I think we're way too inside baseball here. The purpose of last night in the Fed was to make it so that you didn't have to take money out of the bank because you didn't trust the system. You don't have to go bury it, and you don't have to say, wait a second, got to go to an ATM. That was really important. And I think that the Fed did that. Now they have to target commercial paper. They have to be ready for any problems with the mutual funds. They got the treasuries working. Again, I mean, I can talk about, look, I'm very worried about the off-the-run floors of 2000 and X, but that's not the point. The point is they took care of the banking system. Now they have to take care of the working person. Now they have to take care of the businesses. And now they obviously have to take care of these ancillary markets like commercial paper. I guess what I'm saying is they're not oblivious. This is not like 2007 where I was screaming at the Fed to say, do you not understand that mortgage bonds would make it so if you buy mortgage bonds, maybe we can keep mortgage rates low? They're just they're not clueless, Carl. That's my point.
All right, so
they're not clueless.
All right, so if every year we play the they know nothing sound, Aaron, everybody knows that piece of tape by now. Is your point this morning that they know something?
Yes, definitively they know something. And I think that there's a sense that no matter what they do, it's not enough. Well, I mean, like Dr. Fauci says, whatever we do, it's not enough. Remember, this is a biological crisis, not a financial crisis. But I do think that Chairman Powell, might have been critical of, is ahead of the curve. And I know that that's highly unusual to be ahead of the curve. There are many arcane markets out there that are not going to be able to function well because there are a lot of hedge funds that are on the wrong side. And then there's some non-arcane markets that I am worried about. I mean, it would not help for oil to go to $20 because then we'd have a lot of solvency in the issue. I'm worried about oil. I want to be sure that they focus on commercial paper. I want to be sure that they understand the problems at the money markets. I would point out that I spoke to the Treasury Secretary this morning, and he has a lot of what I regard as being commonsensical things that he's looking at, trying to be sure that companies have a lot of liquidity.
Walk us through that, because you do have some talking points that you got from him. What's important?
The most important thing is this notion of, let's take the idea of recession as off the table. What does it mean? I mean, obviously, there's a biological problem. When the biological problem runs its course, you'll feel like a dope. This is my interpretation. If you didn't come in and buy some things. But obviously, Dr. Fauci, some male doctor.
The station you're listening to is experiencing technical difficulties. We have
Dr. Fauci with Fed Chief Powell and with Secretary Mnuchin to be able to come up with a picture which just says, okay, listen, trying to put money in the working person's hand. The banks are going to work. We're going to try to solve the biological problem. But there's I see no real issue in the day-to-day banking system. I see some issue in commercial paper until they address it. And I really do worry about the oil market because that is substantial, and the oil companies don't have the liquidity. And yet they're not on the bailout list. They're not talking about the bailing out the oils because that was something they came to the nuisance.
Yeah. On Friday, going into the show, your argument was Fed needs to buy us some time, as you say, to address the broader health issue. We just heard from Gottlieb, who's talking about late April, early May in terms of peaking, that governors are taking aggressive action, that we are going to change the trajectory because of really a state-level social distancing. Nothing you said on Friday morning, you haven't been thrown off track from that thesis.
No, I mean, I know it's kind of tiresome at this point. It sure wasn't last Wednesday. But flattening the curve, trying to make it so that there isn't a public health crisis, number one. Obviously, we're not public health people. But obviously, that is also something that is life or death. We got to fix that. We don't want Italy. We want South Korea. We have different paradigms we have to avoid. I do find that people do not understand what's happening in Italy. When I say people, I mean like really good people who I wish knew what's happening in Italy. But what I come back to is to say the president and Secretary of Mnuchin's focus is to make it so that someone who's laid off gets paid somehow, whether it's through the small company that laid them off or whether it's directly from the federal government. But that there will be liquidity because they don't want all the small businesses to go under during this period while we wait for the great firms to be able to discover something, or we wait for the flu to run its course. I mean, look, can it be a 28? Oh boy, look at this, a 1918 scenario where it ran its course through October. I mean, that's the worst case. That's not what they're talking about.
No, I mean, Deutsche did a nice chart over the weekend. The 1918 recession was 7 months long,
right?
As opposed to the Great Depression, which was 49 months. And their point is when it's an exogenous shock and it's not about fixing imbalances that are underlying in the economy, it's deep, yes, but it's short.
Yeah, and that's really what's important. You can go back. There's an excellent PBS documentary. It'll take you 45 minutes about what happened in 1918 in the country, where the social distancing cities lost half the number of people of the worst case, which unfortunately was Philadelphia, where they just decided, you know what, let's just have business as usual because that's happy days are here again. It's obviously the business as usual, happy days are here again, and they were winning the war. That's not what you want. And when the soldiers came back, there was a big economic expansion that ended ultimately the recession then. I think that the goal here is not to be able to say, let's load the boat up with the stock of Bank of America. I think the goal is to say that Bank of America is going to be open for business. Don't think about the franchise. Now, that's very different from 2007, where they didn't even think that was important. I mean, I remember dealing with policymakers in 2007, and they were saying, you know what, we're not going to, it would be morally reckless to help Morgan Stanley. No, they're not doing that. I mean, they've learned their lesson. I think that they want to be sure that they're in sync with with Congress, so they don't do anything that is wrong. I have continually told them on background, you guys, do it and then apologize later. Don't be like Ben Bernanke and Treasury Secretary Geithner, which were saying, well, you know what, I can't do this, I can't do that, because, what is it, the Justice Department's going to come after him? Their mothers? I mean, they got to think a little bigger. I keep emphasizing think big when I speak to them. Think big, think big. Right. And when they think small, Carl, I just want to wring their necks, because they're just better than that.
As Fauci said over the weekend, if you think you're overreacting, you're probably doing enough or maybe not quite enough. But it's going to feel like you're overreacting,
right? And that's what I think. Secretary Mnuchin really understands that, and they're not going to play the nicety game of, you know what, I'm very concerned about that because someone might come after me, because there is no someone. There is no someone. There is no federal cop on the beat who says, Secretary Mnuchin, you violated the law. I mean, yes, there are issues involving the 11th Amendment, some states' rights issue. But in general, I think they're ready to figure out, you know what, we're not going to use the law as a reason not to help people. We're going to use the law as a reason to help people.
So this morning, you mentioned you're watching oil. We're back above 29. Do you believe that if the Fed's true mission on Sunday night was to narrow corporate spreads, and they do in fact narrow, that equities would follow?
No, not at all. I mean, I don't think that they're thinking about equities. I know they're not thinking about equities. I think they feel that equities will take care of themselves. As long as they keep the market open, people can sell because they need the money. But when it's over, there'll be opportunities. But they'll talk about it. I mean, in 2007 to 2009, in that administration, they always rebelled when I talked about stocks, because stocks were for rich people. This administration doesn't feel like that. They're worried about the working person, including the working person who has savings in the stocks. They don't have the contempt for entities that are just on the everyday side of doing business. And they're not thinking about, you know what, this entity needs to be punished. That was so often the narrative. I remember the morning of Lehman when they were telling me, we got to punish Lehman. That was an interesting and quaint notion. Right. And we look back and, do we love them for punishing Lehman? Is that what we remember them for? No, we think they were idiots for punishing Lehman. Because in retrospect, it wasn't like that. You ended up punishing thousands of people who didn't do anything wrong. And this administration, or Secretary Mnuchin, is thinking about that. And I find that somewhat reassuring. It doesn't make me want to go and say, you know what, Proctor at 72, I'm salivating. Kind of.
Well, that brings me up to the other topic this morning, Jim, which is the slew of upgrades. And I don't mean to, I know this doesn't sound appropriate given the moment we're in. Right. But today, upgrades of CAT, Clorox, Las Vegas Sands, Verizon, Domino's, eBay, Altria, USB, Costco. Some of them make sense. But is this the time to be reading those?
Early. They're early. I read through all of those. I started the morning early like you did, Carl. And I'm thinking, well, now's the time to make a big bet. I mean, like some of these guys were actually even upgrading oil companies. I didn't see a single upgrade that I thought made any sense whatsoever. As a matter of fact, the opposite. I said, well, you keep your powder dry. You don't know whether we're going to be, you don't know how much we're going to be down today. I mean, is today the day where we're going to be down 13? Is today the day we're going to be down 20? Why not wait and see? I mean, I'll give you an example. And I don't mean to pick on Jeffries, but let me pick on Jeffries.
This is Las Vegas Sands.
Yeah, no, Las Vegas Sands. Who's the full faith and credit of what there? Sheldon Adelson? I mean, full faith. You got to be full faith and credit of these companies. No, of Caterpillar. I like Caterpillar. They're a good company. If they trade to some level where it's an accidental high yield, that's fine. I don't want to buy a single company where the numbers are too high. And Carl, with the exception of Clorox, I did not see a company where the numbers may be the estimates are reasonable. I think they're all too high except for Clorox, where they could go higher. I'm raising numbers Clorox.
The Jeffries call on Las Vegas Sands, the title of the report is Safe to Play in Traffic. And their point is, of the companies we follow, we have the clearest view of LVS 2 to 3 years out. So the duration of patience is remarkable.
Well, look, I mean, they're obviously more patient than the people who own the stock. Look, I think that what you have to think about here is you can think 2 to 3 quarters out. When I'm looking at are companies that say if they go down a great deal but you still need their product, that's an opportunity. Let's take Verizon because it's neutral. Do I think that Verizon's a buy? At a certain level, yes, because they're in the mix of things that you have to have. Do I think that certain department stores are essential? No. Do I think casinos are essential? No. So do I think Carnival Cruise is essential? No. They may want to be able to keep these companies alive, but I don't think that means they want to insure the common stocks. I don't hear anything about that.
Yeah. Finally, Goldman's David Kostin. A combination of tools suggests S&P trough at 2,000. Which is down 26 from here, down 41 from the high. We still expect year-end 3,200, which would be up 18 from here. How in the world are these guys coming up with calls like this? We love David, but we're talking massive assumptions, aren't we?
I was joking with David. I so much love the front call because I think that that's a reasonable expectation. I had thought that we would take out the December 2018 low, which was the one that we briefly touched on that in the pre-market on Friday. Remember, December 18 was a time of great crisis because that was Jay Powell kind of really doing a little too much there on the tightening side. But no, the other side, I was saying to David, look, there's no need to it. I mean, when I speak to the Treasury Secretary, we don't have to speculate where we're going to be when we beat this thing. When we beat this thing, there will be a tremendous amount of pent-up demand. So when you sell here, what you're betting is we're not going to reopen anytime soon, and these companies are going to lose. I just want to be careful. I look at companies and say who's essential and who's not. And I think a lot of us went over the S&P this weekend. Is Occidental? Do we need Occidental, which is obviously the poster boy for lunacy here? No. I mean, do we need Gap stores? No. Do we need Wells Fargo? Yes. I mean, you go down and you look at the yields and you say, well, which ones are the ones that we absolutely need? And then you say, okay, well, who has got the most steady? And I would come back with Altria and Clorox, and maybe I like Procter. I really do. I like the consumer product companies because you need them, and because when you go to the supermarket, you see a lot of Campbell Soup and Kellogg being bought. So, I mean, I spent a lot of time at the supermarkets this weekend just to see what people were taking. They're not booking cruise ships there, but they are taking a lot of soup cans.
I just want to remind our viewers, Jim has been cautious since Super Bowl Sunday. It's nice, Jim, that we can actually go back and trace the date, because that's when you talked to Tepper in Miami. And your views have a lot of credibility going into the chapter we are entering.
I remember discussing with David. I said, well, look, things are so bad. I guess I can't go to the game. I got to go back. And he said, yeah. So I left. I didn't see the game. I brought back the tape. It was kind of, there's a little Pyrrhic down there, go down there, interview Tepper, and then get on a plane back. It looked like a good game. Andy Reid, congratulations. But yeah, I mean, I've been so nervous since then. I'm not saying I'm not nervous now. I am saying that when things happen that you expect, you can't suddenly say, you know what, I'm scared to death. Instead, what you're saying is, okay, I'm going to try to stay healthy. I'm going to go home and kiss my wife, try to relax, read some research, go back to work. Just true. Hopefully when I kiss her, she doesn't have it, I don't have it.
Well, no. Look, Jim, we all had our temperature taken when we entered the NYSE today. That's the new normal. And it does help you understand the guardrails we're going to have to put up, all around, every corner of our life.
I had my wife, I had one of those weird things in your head. Oh, it's better than a rectal. But I mean, you know, I like the ones that go in here. But I had the one on the hip. And she's doing this, and every 4 hours, she goes, Jim, if I'm going to have to do this the rest of my life every 4 hours, forget it. We're going to be in different places. So I said, you know what? Maybe I'll wait till I'm hot. She goes, well, that would be a practical thing to do. Can we also be practical? I like the idea that we want to protect ourselves from others, and I think it's absolutely great what the exchange is doing. But she regarded let's take my temperature every 4 hours as a sign of panic. I've come around to thinking she's right.
Yeah. Not a strategy, as we always say. No. Jim, let's check in with Kate Rogers at HQ, get the latest on the coronavirus today. Morning, Kate.
Hi, good morning, Carl. Confirmed cases topping 169,300 worldwide, with more than 6,500 deaths. Europe is now the center of the pandemic. In Italy, hardest hit outside of China, officials on Sunday reporting the number of deaths jumped 25% over the prior day. That's the biggest uptick of any country we've seen yet. The number of deaths there now at 1,809. The U.S. has added the UK and Ireland to its European travel ban, and the CDC recommending the cancellation of any events with more than 50 people for the next 8 weeks. State and local officials issuing new restrictions aimed at curbing the spread of the virus. Schools have closed in 33 states, California, Ohio, Massachusetts, and New York City also closing bars and restaurants. America's top infectious disease official, Anthony Fauci, urging Americans to stay home, saying that new guidelines on curfews and social distancing will come later today, warning of a spike in deaths if behavior does not change. The White House's coronavirus task force is promising a major increase in the availability of testing this week, rolling out 1.9 million tests to 2,000 sites, an increase in confirmed U.S. cases now at more than 3,700, and deaths at 69 is expected. For much more on this, check out CNBC.com. They have a live coronavirus blog that's been fantastic, and they will continue to update as we move ahead, guys. Back over to you.
All right, Kate, thank you for that. Jim, I do want to turn to you on some Regeneron headlines this morning. Working with Sanofi on a trial for severe COVID-19. The U.S. trial will begin enrolling patients immediately. How closely are you watching some of this?
I'll have Regeneron on this evening. I spoke with him this weekend. I have to tell you that of the companies that are ahead, I think Regeneron's well ahead. But that's also because, remember, they had the first one for Ebola, and they have a very seasoned team. By no means at all is Len Schleifer trying to reassure me. He's just saying, listen, we're just constantly working on this, and it's our bailiwick. This is a company that works on these, so I think that that's very early that they're doing. I mean, that's really ahead of the game. I can't wait to speak to them tonight. The biggest problem, obviously, is when you do a vaccine, is you have to titrate. You can't just suddenly do a vaccine and then load people up with something that kills them. So even if they're doing that, that's still in record time. But we have to always be sensitive to the idea that in our country, we do not put something that can kill you in your body until we're pretty sure that they're not doing it themselves. They're not killing you unnecessarily.
No, I don't mean to harbor any illusions about the speed of this, but you do want to look for signposts of progress on social distancing, these new CDC guidelines and no gatherings of 50 plus, the trials on the vaccines we're going to eventually need, right?
Yeah, and look, I think that when I listen to a lot of the coverage, I really come back to the one thing that's been missing, which is the notion that we are going to solve this ahead of the weather, ahead of what they did in 2018 when it just the thing went away. We have really, really good people who are ahead of the game. Len Schleifer's Regeneron, again, which will be on tonight, I'm confident they actually will have something. When people say, you know what, when Dr. Fauci says, and by that point X will have a vaccine, what he's talking about are things like what Regeneron's doing, which is to say, okay, every second they're working on a vaccine. I know when I speak to the Moderna people, they're quite confident they have something. I do have a little more faith in Regeneron just because they were well ahead in Ebola, and that they wanted to come on tonight shows me that they're not screwing around. They've got something. So I think you're right. I mean, social distancing, yes, you don't see anyone near me, and I'm as concerned. Did I wear the gloves? I mean, do all the things that you're supposed to do. Is it nauseating to do it? You just have to do it. The life has changed. But yeah, I mean, we want to stay healthy, but then we also have to count on our institutions, like places like Regeneron, to be working on things, and that's what they're doing. So I wish that people would not think, you know what, we just have to wait for Mother Nature to run their Mother Nature. Wow, thanks to run Mother Nature on the wrong side of the equation right now. We just have to wait it out. I think that what we can do as a network is focus on companies that are so in sync with what we need. Dr. Fauci's not going to come out and say, don't worry about it. And Mayor de Blasio, man, I have to close my restaurants tonight. Well, big deal for me. But, you know, that's a lot of money for small people.
I was thinking about you.
Yeah, I mean,
this weekend,
I was trying to figure how long can we keep people? We'll keep people on for as long as we can. I would like to, when I speak to the Treasury Secretary, they're talking about target stimulus for just the kind of outfits, not for me, but for kind of outfits that we're talking about to keep people on the payroll. But I really think, Carl, that when we hear that it's just going, we have to let it run its course, that denigrates some people who are so good and are working so hard, and I think come up with something. And I have tremendous respect for them.
It's interesting you said that, because the rally on Friday coincided with the appearance of Macmillan of Walmart in the Rose Garden and Cornell from Target.
Right.
Talk of Google, at least, although the messaging on that was arguably poor. Navarro today talking about FedEx's Fred Smith helping him get some materials back to this country. LVMH making hand sanitizer for the French. How much is the market looking to corporate America for response?
Well, a great deal, I guess, in that sense. And I just want to correct. It's Regeneron moving to tomorrow. We have CVS, because CVS was in the White House garden. We want to find out what CVS is doing. We have Thermo Fisher, which is also involved with this.
Oh, also good.
Yeah, they're also involved. I'm looking to Thermo. I'm looking to CVS and seeing what they're capable to do because they were one of the companies that were in the Rose Garden. I'm looking to Dow Chemical, just because I think that uniquely we're looking at high yielders, trying to figure if they can make the money. And then Regeneron tomorrow, we'll be able to say, okay, how far along are you actually? Those of us who actually run tests, I have run tests. Regeneron tomorrow, yes. I have run some tests and done some work in the medical community. I can't believe the speed they're going. I mean, I just to work on a drug that I've got, which I think doesn't hurt anybody. It took 7 months just to get to the point where we can even think of enrolling people. This is so rapid. I can't believe it.
Yeah, it's incredible. All of us are learning a lot about biotech in ways we never expected.
Yeah, you know, Carl,
Jim,
you have to understand, these companies, they weren't set up for this. I mean, they're set up to be able to take a long route. You're not allowed to front run things. You're not. The FDA usually just makes it say, listen, when you get this into the review board and when they sit down and they do the 40 questions, you'll come back to us in 7 months and then we'll run a trial. And 2 years later, we might find the results. And I hope you're ready to spend $500 million. Boy, we're not getting that at all, Carl. Not at all.
No. No, I mean, emergency authorizations are now the norm out of the FDA in the past week, which has been amazing to watch. We're going to watch circuit breakers at the Open, and for that, we'll turn to Bob Pisani this morning. Hey, Bob.
Morning, guys, and everyone here at the NYSE is at work. You see the people behind me. Obviously, we had some temperature checks. I'll show you some B-roll in a moment here, but let's review the circuit breakers. We've done this several times in the last week or so. There's 3 levels, 7, 13, and 20. Level 1, 2, and 3. Level 1 or 2 circuit breakers before 3:25 p.m. will halt trading for 15 minutes. After 3:25, there is no market halt unless you drop 20%, and that would halt for the rest of the day. A little convoluted, I know, but these were the circuit breakers, and they were instituted. These changes were instituted back in 2013. A lot of concerns, of course, that we are limit down. We've been limit down in the future several days last week. But remember, the ETFs continue to trade, and they have been very good at sussing out roughly where the market's going to be. We saw this on China. They were closed for a week or more, and we saw the Chinese ETFs here trade with remarkable accuracy. Right now, the S&P 500 SPY, that's the biggest ETF, closed at 269 on Friday. You see it at 240 right now. That would imply a decline of somewhere at 10.5% to 11%. It's been bouncing around a little bit. Triple Qs, also another ETF, Diamonds DIA, also implying similar declines that we've seen. A lot of people trying to figure out bottoms over the weekend. We know for sure this is not working right now. You see all of this up and down here, down big Monday, up on Tuesday, down on Wednesday, down on Thursday, up on Friday. Stock pickers pride themselves on pattern recognition. A large part of technical trading is based on this, but obviously that's not going to be working, and we need to figure out some sense of when infections might begin dropping. Obviously, that's got to be at least several weeks away. You heard from Wilf talking about the banks. Most of the banks set to drop in the mid 15s, let's call it 15, 18%. Citigroup, Bank of America, Morgan Stanley, JP Morgan, all suspending buybacks. Finally, we were all greeted with a rather remarkable sight this morning coming to work at the New York Stock Exchange. All of us were required to take temperature checks. So these were checks through the forehead. They're remarkable just watching them do this. But we all had to fill out a form asking us if we were working on the floor. If we were, the form asked us whether we had a temperature, whether we were ill, whether we had been outside the country. This is what the modern world looks like right now. But the New York Stock Exchange is going to open. Trading will open. There will perhaps be a trading halt at the open. But nonetheless, throughout the day, the markets will be trading. It's the new normal, but again, as far as I can see, this is a pretty full contingent of people here on the floor. Carl, back to you.
Our Eunice Yoon working on another piece about this chapter that she's already been through, Bob, and says it gets better. So we're waiting for her to finish her piece and get that up on .com. Let's get to Cramer's Mad Dash and get before the market open. Jim, what are you watching?
Yeah, again, I think that the pressure point is no longer in the the Treasury market, which we can focus on, but I think that Jay Powell took that off the table. The pressure point, I think, is oil. And there's a note by RBC Capital today. I never thought I'd see this, which is taking ExxonMobil from hold to sell, really saying that this is a company that is not set up for the lower oil prices. I think those of us who know Exxon from the days of Rex Tillerson would find this an unbelievable thing that we actually have to focus on Exxon as a company that we need to worry about. I think that they need oil higher than 30. They don't have it. I think that oil could go to 20. So I'm saying that when you see a company as fine as Exxon being downgraded to sell, you got to be very careful with that group, because a lot of that group has very, very high yields. And I think a lot of people are looking for yield, and I'm urging you to look for yield away from oil. Do not trust the oils.
Interesting.
Don't buy them.
I wanted to ask you, Jim, about the Saudis today. Aramco CEO assessing, as we know by now, their ability to raise capacity to 13 million barrels a day. We can sustain low prices for a long time, they argue. I mean, what? Do they sense vulnerability?
Yes, they really do. I mean, look, they're not our friends. The Russians are not our friends. It's every person for itself in the oil business. And I'm looking at these and I'm thinking these are very, very fine companies. But there are a lot of people trying to figure out the real break-even points. There are people who are triaging certain stocks, Occidental's being triaged. People just realize that they borrowed too much money and they don't have it. So let's stay away from those. Don't reach for yield. Now, some other things I went over with the Treasury Secretary.
Oh, yes.
Yeah, I mean, look, he's very grateful for Jay Powell. A lot of people feel like, where's Jay Powell versus where the president is? And I know the president, at least through Secretary Mnuchin, has finally recognized that Mr. Powell has gotten ahead of things, and that's very important. I do think that, again, the stimulus is going to be focused on small businesses and keeping the working people in jobs. Liquidity for small businesses is the chief priority. The chief priority is about putting food on the table for individuals. I think that a lot of people who watch the stocks would say, well, what is the impact of that on stocks? And I would say nothing. They're not trying to save anybody. They're just trying to make sure that the employees get paid. That is an attitude I think that both Republicans and Democrats are probably going to agree to. And I think that Secretary Mnuchin is, because he was a trader, because he understands the markets, and he also has a touch to recognize what Speaker Pelosi likes. It makes it so that there's a lot more unity down there than it may seem.
Interesting. The bank suspension of buybacks, Jim, is that mostly about optics and not about balance sheets?
Yeah, I mean, look, it's very hard to go borrow be able to borrow with a discount window to go buy stock. The banks are going to have big yields. The banks, I think, are a better place to go than the oils. But I don't know at what level they're intriguing. I mean, you get a Wells Fargo run by Charlie Scharf, and you say that yield is probably good because the dividend has actually been the same the whole time. Obviously, the stock has fallen a lot. Do I want to bank with Charlie Scharf? Well, if I have to bank with someone, I would. But I recognize that anytime you said anything good about a financial institution in 2007, you ended up looking a little bit like ill-advised. You look ill-advised.
Yes. There is the opening bell and the S&P 500 at the CNBC Real-Time Exchange. With the big board, it is Chris Taylor, Vice President of NYSE Listings at the NASDAQ Foster Pride, helping children and teens in New York City foster care. So we're going to watch for 25.21. That's your first circuit breaker. And at 24.90, Jim, it'll be halted at the open.
Yeah. I mean, look, remember, we had that weird short squeeze in the last hour, Carl, and you knew that had to be wiped out. Very few people were able to get there for those prices. I would be in no hurry, but one of the things I tweeted this morning was like, if it goes down the limit every single day, by Friday, we don't have to worry about much. And I'm being a little facetious, but let's take into account that there are people who need their money, and they need their money, and they're not needing their money and saying, you know what, I think that this is the level where I want to take a big swing at General Mills, which reports this week. I think what they're saying is, I need my money, I don't care, and they're usually using S&P. And because it's S&P, they're going to create values, because not all stocks are created equal. We got 60% of the money is obviously an index. And so when you blow out index, you're blowing out some companies that shouldn't be sold.
No, it's a dynamic we have talked about for years, wondering when that reckoning would come. Obviously, we're in the thick of it now.
Right. I mean, look, let's say Verizon we're looking at Verizon at 50. Let's say it goes to 45. Do I want a 5% yield that's backed up by the full faith and credit of every single customer in Verizon and a good balance sheet? Yes, I do. I mean, I like that. And why is it going down? Because it's in the index. It's not going down because anything's wrong with it. It's going down because we became an index nation, because the industry convinced us that we don't know anything about individual stocks. I've always felt and dedicated my money idea that you should have indices, but you should own some. But because of the craziness and lunacy that we see where all stocks go down equally, some stocks should Verizon trade like Southwest Air? And I like Gary Kelly so much, but the answer is not all stocks are created equal. And those who think they are created equal are doomed to be able to not be able to profit when this thing's over. By the way, notice I said when and not if. I mean, I don't think we're in a permanent state of end of days. I just don't think that. I'm sure even in 2018, in the month of October, where people where there were carts to carry people away, we're just not there. We're just not there.
Your point's a good one, though, about the swings. Peter Schacknow is a great statistician of ours and says during the financial crisis, from Lehman to the Haynes bottom, so September 08 to March 09, S&P had only one day where it fell more than 9%, and that was in October. And that was only 8.9%.
Wow.
The average daily move of the S&P was 2.5. So now we got these 7% moves at the open, a couple times a week. That's why this feels more extreme.
Exactly. Well, we all love Peter. And I would say that a lot of what you're seeing is dislocation. Remember, there are a lot of firms that are always on the wrong side of the trade, and they create opportunities because it's the hedge funds going wild. They don't know what to do. And I would urge people at home to say, you know what? These are companies. I mean, am I saying think like Warren Buffett? Well, Warren Buffett would say you got to do indices, and I really appreciate that. But the indices are not reflecting the real values. Believe me, I think that there are some very common sense companies. Now, 2 years ago, April, you had Amazon go to 1,300 because the president decided he didn't like Amazon. Amazon is the way that we're getting in just a 2-year period, Amazon's the way we're getting our goods. Do I think Amazon's a buy at 1,600? I know Amazon's got, believe it or not, actually a great balance sheet now. And I think that there's a level where I want to own Amazon. I don't think it's here yet because I know it traded at 1,300 in April of 2018. So why can't it go there again? I'm trying to figure out what stocks went to prices that I actually remember. And if I remember, it's probably too early to buy them.
Yeah. It's funny, Jim, I don't want to, we can save politics for another day, but I wonder, given the antagonizing back and forth between Amazon and Navarro, Amazon and the president, is that an inhibitor for Amazon to use their supply chain expertise to our national advantage?
Well, that's a great question. I mean, I think it would be, there is obviously political risk to Amazon, but and if you felt that they didn't know what they were doing, there's another company that doesn't have political risk, which is Walmart, that has a very, very good, really terrific business and is for online. They're great online and offline, and obviously they're committed to helping the president. Witness Doug McMillan's comments. I think that it's very interesting what happened at that press conference. I know that Google was caught a little blindsided. I think that the executives didn't go into that meeting expecting that the parking lots were going to be the place that people are going to get tested. They sure did leave thinking that, and they made a commitment. So I think that'll happen. I do think that people who think that if you go to the Walmart on Route 22, which is a very nice Walmart, by the way, I don't think that you're gonna. That's the day. I mean, today's not the day.
I think people understand. Like, this Google website is apparently, according to reports today, getting off the ground in Northern California. The messaging is hard, Jim. I mean, even Lagarde had to backtrack her notion of, no, we're not here to narrow spreads, and she later essentially apologized for that.
Well, look, I think there are a lot of things on the fly. One of the things you said, we don't want to do politics. There are many people who are very critical of everything, and I would point out that if you just step away from me, I watched the beginning of the debate last night, and I'm not talking about the president. I'm talking about the people who put things in place. Like when you listen to Fauci, you listen to the healthcare people. I mean, these people are pretty serious, and what they're obviously focused on is flattening the curve, making sure that we don't all get sick at once, or hopefully not get sick, but that everything's being done on the fly. And why anyone would think that Jay Powell is now done? I mean, they're trying to anticipate everything that could go wrong. I think the thing they anticipated, and I'm so glad they did, was that last time around, people pulled a huge amount of money out of their banks. And that made the banking system really unstable. And they just didn't want that.
Al Arian's point this morning was about sequencing, and as we're talking, Jim, FDIC and the OCC are joining the Fed in urging banks to borrow at the discount window. Our Steve Leisman says it's an incremental move, but definitely worth a mention.
Yeah. Look, I just think that everybody is focused on making it so that the banks function and the Treasury market functions. And then when they're done with that, they're going to look at other things. You know, they only have so much thought power. There are hedge funds out there who think they know everything. I'm sick of them, frankly, because they always seem to know more than we do, and then they turn out to not do. When you're a billionaire, by the way, you don't really have to focus on the things that the people who have $400 in the bank account do. These people have long since forgotten what it's like to have $400 in their bank. I think
Jim,
that's what they're worried about.
Last few years, I mean, a well-known statistic has been the percentage of households that don't have $400 in emergency savings, and that's where the helicopter money is going to have to go.
Exactly. I mean, that's what, I would love to hear from Speaker Pelosi. Try to get her on Friday, because you try to figure out where the common ground is. We know that Treasury Secretary Mnuchin was actually joking about how many times he spoke with her, but the Treasury Secretary doesn't want to get ahead of Congress, and Congress, from what I can tell, is trying to help the working person too. There are many people who are actually quite surprised that there could be such a convivial attitude between the two. But Secretary Mnuchin is not an ideologue, and Speaker Pelosi wants to be sure that the money gets in the hands of the people. So that really, when I speak to both of them, that's where I keep going. Even, look, I got to tell you, I had former presidential candidate Warren on. There's not that much distance between any of these people, because they all worry that the working person, the $400 in the bank person, is going to get hurt. No one is trying to figure out how to save Burger King.
We're going to talk about restaurants in a little bit. Upgrade of Domino's today. You can sort of understand why.
Domino's has a very good system, and I think that that's predicated upon the idea that there won't be enough money for the companies that are private. There's not enough money for Postmates. I don't know. I mean, I think Postmates has got a decent situation. We know we met the DoorDash people. DoorDash has the backing of some very big firms. But if you felt that Domino's has long since felt that those guys are the bane of their existence, if those guys run out of money, then Domino's is terrific.
I agree. And we saw over the weekend, if you noticed, Jim, they sent out an email offering contactless delivery, where you don't have to actually really see or touch your delivery person, that's just a sign of where we are.
Well, that's the Chinese did that. I mean, at least they're not putting their thermometer on their head. I mean, like my wife is doing.
Let's get to Bob Pisani and see where we are in the circuit breakers. Bob?
And I had a thermometer on my head this morning. It was an odd experience, but it was effective. I got in, and it's a necessary step. Again, we want to review. I know we're all become scholars of circuit breakers in the last week or so. Level 1, which is where we are right now. We opened down about 8% on the S&P. We'll reopen 9:46 or so Eastern time here. That will halt trading for 15 minutes. Level 1 and level 2 will kick in at any point up until 3:25 p.m. Eastern time. After that, there is no trading halt unless you drop 20%. Then you halt trading for the rest of the day. I know it's a little convoluted, but all of us gotten used to the business about this. We don't know where the market will open here. Obviously, we're down about 8% on the S&P, but the banks were weak this morning. They announced they're going to suspend. Most of the major banks are suspending their buybacks. The theory here that they're going to divert the money into loans. Let's hope that is indeed the case. But you see, these are pre-opens on the banks here, rather severe drops overall. Where's the support levels? Not necessarily mean a lot. I think the one thing here is 2,500. That was roughly the lows that we saw last week. Here's a 2-week chart of the S&P, but 2,500 would be an important support level. But there you see we're breaking that here. After that, you're looking back here at December 24th, 19. That was 25.31 there. That was the close there, 25.31 on December 24th. And that was the important level here. We'll see if that kind of number is 23.51. I beg your pardon, 23.51. Let's see if that holds. 23.51. Let's see if that holds. Obviously here we're just a little bit below that, above that right now. Let's take a look at what the debate is. The parameters of the debate. Is it U or L shape? That's been the debate all throughout the week and the weekend. The U shape people argue that the service economy will bounce back in a few months. The L-shaped crowd, which obviously has the ascendancy right now, is arguing the bounce is going to take longer and that small business will be affected for much longer than just a couple of months. And as you can see, the market is acting like the L-shape may be more likely than the U-shape. We'll see if that changes around. By the way, the V-shape is gone. You notice nobody's arguing about a V-shape. It's interesting that we're having buy recommendations today on a number of stocks. Caterpillar, for example, upgraded to buy from hold over at Stifel. There are people who are trying to call bottoms at this point. I think it's a pretty bold move, but you can see it's not really working. That stock's still down. We're waiting for that to reopen. Clorox, maybe more understandably, was upgraded to an overweight at J.P. Morgan. We're going to reopen in about 4 minutes. I'll be back on the floor. Some of the stocks may take a little longer because there's going to be some manual opens on some of the bigger names that are out there. So I'll be walking around on the floor checking on the open. Guys, back to you.
Yep. It's nice to know the floor is well populated and monitored temperature-wise coming in, as we said earlier. Jim, you were mentioning liquidations earlier. I mean, gold's off $62. Is that a part of that story?
Yeah, I mean, deflation. Once again, I just feel like that when we speak to Secretary Mnuchin, I want to just understand that they're looking at things that people say, why didn't they look at? Looking at commercial paper, they're looking at liquidity. And I just think that anyone who's selling stocks on the basis that they don't know what they're doing is really missing the point. I mean, even to the point where they're just in touch with us constantly. And they're in touch with us because they're very much aware that what they can't solve, they're going to go to Congress today on because they want the authority. Obviously, there's some authority issues. But it's very much of a deflationary situation, Carl. And look, if I had to advise people about what to do at the very moment, I mean, gold is under a lot of attack. If you really believe that where we are is at a moment that is apocalyptical, obviously you buy gold. I just don't share that. I mean,
nobody wants to go there, Jim.
No, I mean. Look, I mean, it is difficult when you're trying to figure out whether to have a studio at your home and say, well, geez, I got to get that cleaned up and maybe take that poster down. But I do want to point out again that other than Italy, and Italy is a great quandary to me because I've used their healthcare system in several instances, and wow, it's a good one. So I think that's, other than the fact of a lot of people being old and they have a lot of people smoke, I keep trying to figure out when will Dr. Fauci tell us why we're not Italy. That would be terrific, but he's not going to do that because it doesn't want to reassure us.
People point to smoking, pollution, the degree to which the elderly live with family members, Jim, in ways they don't necessarily in this country.
Yeah, Dr. Fauci, I mean, a lot of the people in health know that the major reasons why people got sick in China in such clusters is because one person gave it to the rest of the family. And I'm sure that's the case in our situation, too. That's going to happen. But I look at what I'm still not seeing opportunity yet is what I'm saying. There will be. But I've got to tell you, Carl, if we're going to take out all these different circuit breakers and then take them out, let's see. There is a day called tomorrow. And you're going to come in and you're going to say, well, wait a second. The calmer heads have said that a lot of the hedge funds that got blown out between 12 and 2, which is when they'll have to do meet their margin call, they did their second level of selling. And now I'm going to pick and choose. It's just that we're so index-oriented, Carl. It's so difficult.
I know. Not just that, though, Jim. A White House briefing has now been moved to 3:30. Oh. And the fact that it will happen during market hours, it's up to you to interpret.
Well, let's just say that if it's Secretary Mnuchin, I feel that he's very much aware of exactly what we're saying and where the markets are. They do need to have something with Congress today. We need to be able to say that there's no spitballing, that what they've done is try to figure out what was over, what with Dodd-Frank, what has made it so that they're clearly limited, and they're trying to get that taken back very quickly.
All right. So there's the bell. Trading resumes. S&P down 253. We're going to watch this all very closely, Jim. Bob was looking at that chart. And we did talk last week about December 18 levels as a marker. How relevant is that in your mind this morning? Jim?
Oh, I'm sorry. I was just trying to get the sense of what's going on there in Washington.
Oh, yeah.
Yeah, I'm doing my best here. Highly unusual. I just think that these levels they're just things that I do want to buy today, but they're just not down enough. Let me give you a classic example. Let's say J&J. I mean, here's why I pick up J&J. AAA balance sheet, okay, best balance sheet in the world, okay, in the world, better than Warren Buffett. And I look at it, and it only yields 3%. And I say to myself, as much as I like Alex Gorski, as much as I like so much about what they're doing, that is still not at the level, down 14% for the year, where I feel it's a layup. I want 4% yield. I want 4% yield. And if I stick to my guns, I'm going to get it, Carl.
You may get it, Jim. You might. We're going to watch that one. While we have time, and as the S&P is down 277, let's check in with Rick Santelli. As you know, the CME has closed the trading floor until further notice as a precaution to reduce large gatherings in the wake of the virus. Rick, we did get Empire, and we might as well get used to numbers like that.
Yeah, can you do that?
Absolutely. We should get used to these numbers. They're going to be like this, and they're going to get worse, actually. But remember, and first of all, it is really weird, people, to be talking without all the background traders and the noise in the background. Thanks to the CME and our wonderful CNBC crew, here we are bringing you all the important market information. But in the end, exactly how things are going to turn out, I can tell you this. When we start getting the data that really quantifies what we saw in today's Empire, then all of a sudden, we're going to be looking forward to the comps as things improve. They say there's no V bottom. There will be the right side of the V bottom whenever the coronavirus, of course, starts to retreat. And it's going to happen at some point. Look at these one-week charts and realize that all the extremes, especially in the fixed income space, were established on Monday, March 9th. So 2-year note yields, here we sit. Right now, they're at 35 basis points. So they're down, about 13. But you can see the low today, intraday, was 26. Last Monday, it was 24. And that is a very significant bottom. 1 week of 10s, it was 31 last week. It was 62 today. 2s to 10s were approaching the high 40s, but today is a major flattener. 38 now, 10s minus 2s? And if you look at 30-year bonds, this is the most important maturity, in my opinion, to pay attention to. 1 week ago, their intraday low was 69. Now it's 125 was the low, and it's moving higher. It's all the way back up to 136. Finally, let's look at Boone's overseas. They've had 4 higher yield closes in a row. Today may be the 5th. And the dollar index has had 4 higher closes in a row, but it doesn't look like today's going to be the 5th. Remember, in my opinion, the Fed could do all they want. The key issue for global markets is to satisfy dollar demand. And I think many of the programs initiated by the Fed, especially swap lines, these are going to be ultra important in the grand scheme of things. Carl, Jim, back to you.
That's a great springboard, Rick. Thank you. Rick Santelli in his new environment. Jim, let's talk about that dollar swap because we didn't really get to that on Powell's presser.
Yeah, look, I I understand exactly where. I think I understand exactly where Mr. Santelli is coming from. I mean, and he wants to make sure that that's the issue is the dollar. Some people want to make sure that the issue is the buck at the mutual fund. Some people want to make sure it's commercial paper. I would just say that all these issues are not, let's say, they're on the table, and the Treasury's not obtuse. And so but you don't want a Dutch boy situation. You don't want Secretary Mnuchin and his team say, all right, now I got to put my finger in this one. I got to put my finger in this one. What I'm saying is that they see what we see. And that it's about attitude, Carl. The attitude in 2007, 2008 was, you know what? It serves you right. That was Treasury. And the Fed was, we're good. What's the issue? This is not the case. We've got a Federal Reserve that clearly understands what went wrong in 2009. We have a trader who is the Treasury Secretary who is saying, yeah, absolutely, we're going to be able to deal with these things. And yes, the one thing that they're not talking about is what is the ratio of people who get sick versus people who spread it. I mean, they're all trying to say, look, we're going to handle the financial side. We can't handle the virus side. That's other people. And while Rick says that it's the dollar and other people saying it's commercial paper, believe me, what they're saying is we're going to hold it together financially, but you got to hope that we hold it together biologically. And that's what I think that when we get in the weeds is we worry about individual programs, because this is not like 2007. They are listening. They are hearing what Rick is saying. They're saying, you know what, we're addressing that. Do I even ask them about hospital beds? Okay?
All right, so
I asked about hospital beds.
To follow through on that line of thinking, Jim, if we go with Gottlieb's, it sounds like his base case, which is a peak in late April or early May, investors, markets are going to need to have stamina for a matter of weeks, right?
Absolutely. So what you're looking for, I would say, are companies that are selling through cash, or companies that have the ability to survive no matter what because there's demand for their products. And I think that that's the way you want to analyze a stock. You want to say essential, non-essential. Essential, non-essential. And we know a lot of companies are non-essential. Is the third-tier oil company that we all knew as being, say, a $40 stock, is it essential now at $2? No. We're going to speak to Phil LeBeau. The question is, we need an airline system. Nobody's denying that. But do we need an airline system where the companies make a lot of money? Well, that's not what the president's thinking about. And I think we have to think, all right, what company without help from the government will get through to the other side? And that is probably going to be a buy.
I feel like Annie Hall here because I happen to have Phil LeBeau right here. Phil, what do you think?
Jim brings up a good point. I do know this. Strictly when you look at the cash situation for the airlines, they are in dire situations right now. Doesn't matter which one you're talking about. When you talk with the executives, the tenor has gone from, well, this is going to be a rough patch to, whoa, this is really bad. How bad? Look at the capacity cuts. You've got American cutting 75% of its international flights. United announcing last night 50% of its system is going to be brought down. Delta bringing down 40% of its system. And listen to the commentary from the CEOs. Let's start first off with United. Last night, CEO Oscar Munoz sending out a note. He says it is getting worse. That's what he's talking about when he says the situation with demand. Delta CEO last week says negative net bookings for the next 4 weeks. And then you have American. It's grounding 90% of its long-haul planes, sitting them down completely. They're not going to be flying anytime soon. Finally, Southwest, it has not yet cut its summer schedule. That's the one we're going to be looking at today, seeing what happens. And of course, Jim, we're also watching to see if the White House says anything about further travel restrictions. I kid you not, Jim, I have not heard this type of tone from executives in the airline industry since shortly after 2001 and 9/11. That's the last time I heard them with this level of concern in their voices.
Yeah, that's absolutely right. I mean, what really concerns me, Phil, is that they don't have any control of their situation. Their destiny is sealed by others. And Phil, when I listen to you, what I say to myself is, wow, which one of these is not thinking about the loss they're going to take this quarter, but is thinking about, okay, how do we come out on the other side, even if it means that that the shareholders are not rewarded.
Right. And think about these airlines, fixed costs, Jim. They've got equipment trusts. You know, they've mortgaged some of their aircraft. Well, how are they going to be making those payments? Now, look, they're fine for the next month or two, but increasingly, they need the revenue. United Airlines, $1.5 billion less in revenue this March compared to the March of last year. I mean, that is ridiculous. They are hemorrhaging cash. That's why when you listen to these CEOs and when you hear what's coming out of the White House, there's a bit of a disconnect there. Yeah, the White House says we're going to stand up for the industries like the airlines. Well, the airlines are saying, this is not enough to say you're going to stand up for us. It needs to be done quickly, real quickly, as in soon, like this week. So I'll be curious to see what happens.
Maybe the White House will have something to say about that at 3:30. Jim, Fitch did take Boeing to negative credit watch on Friday, I believe. I mean, there are going to be implications for long-term orders as well, right? Especially given what we've already been through on the MAX.
Yeah, I'm in touch with Boeing, and I know that they're a pressure point in the system. I know that the Treasury Secretary and the President are focused on Boeing in a positive way, obviously. I know that the CFO is very, very savvy. They took down the revolver. You do have to worry with Boeing. They have manufacturing suppliers all over the globe. So they have factories, 2 factories in Italy. So what happens if the 2 factories in Italy close? Well, that means that they could have trouble making the Dreamliner. And the Dreamliners is what providing the cash. So are they on the red-hot griddle? Absolutely. I don't know how to take them off it. I would not recommend the stock here. I think that would be ill-advised of me to do so.
Right. Meanwhile, is Phil still with us? Oh, he did. Okay, he stepped away. Yeah, I see Virgin Atlantic is asking staff to take 8 weeks of unpaid leave. That's where, obviously, policy response is going to be key. Jim, I mean, I know it's early, but 2,400 did hold.
You know, look, you have to just pick. You have to look at the components, and there are things that I think, again, that I do want to buy. I mean, I think that Verizon is cheap. I think that I'm trying to figure out whether Verizon is 50. It's okay. It's not bad. Let's take a look at Procter. If you buy Procter here, you're getting 2.74. That's not enough. I'm doing yield analysis. I'm looking for stocks that have an accidentally high yield because their stocks have fallen. And I'm looking for stocks that are not appreciably that far from their lows within the last 2 years. And I think that's a good thing.
Have a reason for being in this new world order.
Yeah, and then when the smoke clears or when the illness goes away, they're necessary. Darden reports this week. I mean, that's a tougher one. I mean, do we need Olive Gardens? I think we need those people to have jobs who work there. I think that's a secondary. You know, your first check down, if this is going to be football, your first check down is to look for companies that have a lot of cash that are going to be needed after the illness is conquered. Your second one is to say, all right, what companies have good dividends that have decent cash flow that I think can get through this? And then your third one is to say, I don't want any of these companies because they could be cash strapped. And you're thinking about some retailers, restaurants, airline, travel, leisure, hotel. Those are very hard to reconcile.
Yeah. I'm looking at point contributors, or in this case, detractors, Jim. UNH is actually the biggest, 209 Dow points. Boeing follows with almost 200, and Apple's third. Dow's got some quirks we all know regarding price activity, price weight. But that's sort of where the laggards are hurting us the most.
Right. I mean, Apple's problem, it was at 170 back in June of 2019. So it's kind of like there's another one where I say, well, I remember when that stock used to be much lower. UNH was lower during the period when Elizabeth Warren was attacking them. JP Morgan Chase obviously is an outlier. That is very, very low, and that might be interesting after in a couple of days. Might want to do that. Boeing is problem. Yeah. I think.
I mean, all right, good. I know. I only asked because financials, I think, is the worst performing sector, down
terrible,
14.
But let's say J.P. Morgan had this decline every day. Remember, let's say it got back to 54. I mean, that's when Jamie Dimon made his big buy and called the bottom. I think that this time may be similar. I know that's far away from here. Wells is very interesting because, again, it's Charlie Scharf. He's rebuilding the bank, but it's still got its tremendous franchise. But you're right, Carl. I mean, I didn't want to put the banks on with the oils because they just trade so awful for so long. But there's a level where they're interesting. They're not going to be as interesting as buying a staple, though, or buying a utility, or buying a drug stock. many of the drug stocks are very interesting to me.
Real estate, the best performing sector today, which is down only 8%. Jim, so CVS tonight?
Yeah, I've got CVS. I think let's see how they're handling what's going with the president. Thermo Fisher is the company that I think has the tools to be able to win the war, and I think we should be calling it the war. And then Dow Chemical. A lot of people are saying, "What do you do with these companies that have big yields, Jim, that look like they can't be sustained?" And I know that Jim Fitterling is going to explain to us why that it may be an actual buy. There are other companies, by the way. DocuSign, okay, I really like that. I really like Zoom. Why do I like these? Because, Carl, if I have to work at home, I'm going to need DocuSign. I did a DocuSign deal on Friday. I didn't want to deal with any of these bankers. They're the last people I want to touch. And then, hey, you can only have so many gloves when you're dealing with bankers. And then I think Zoom is, well, how are we going to communicate? We have to have Zoom. And Zoom is the winner here. When the smoke clears, people are going to forever change the way they do business. Turns out to be pretty good at home.
Jim, stay healthy. We've never been more grateful that you're a germaphobe to begin with.
Well, just saying, Carl, I got the thing. Hey, you know what? You got to go like this. You're supposed to take it to your hairline. Man, I'm going here and stuff. But no, I mean, it's right to here. I wish they were a little more sensible about the follically challenge to know how high you got to go.
Yes. We'll see you tonight, if not before. Our Jim Cramer, thank you for your commitment and your energy. Let's get to Bob Bassani on the floor. Hey, Bob.
So we had our initial trading halt. This would have been the third one in the last week. We halted at 9:30 or 9:31 between there. Limit down at 7%. We reopened at 9:45, 9:46 or so. We hit a low. It was a little 24.09 or so, let's call it. We're off of that low. We're now at 24.47. If you take a look at the sectors, this is one of those, I used to call them global takedown days, where essentially most of the market is down 10, 11, 12, 13%. It doesn't matter if you're looking at financials or energy down, real estate's down as well, materials, technology, everything down 10, 12%. The REITs and the utilities and REITs a little bit better, but not much, frankly. Banks we've been talking about all day. Most of the major ones have announced suspensions of their buyback program. They are saying they are going to use the money instead to give out additional loans. We'll keep an eye on that, of course. Let's just review the circuit breakers again. As you all learned last week, you drop 7% once, you halt. But then if you rally back and then you're down 7% again, there is no second halt at 7%. At that point, you go to down 13%. All of this applies until 3:25 p.m. Eastern Time. After that, there is no trading halt unless you drop 20%, in which event you would halt for the rest of the day. I do want to point out that big effort here to get all of these stocks open. And remember, here at the New York Stock Exchange, it's not an all-automatic open. It's not an all-electronic open. There's an attempt to do price improvement by the market makers. So sometimes, and in many cases this morning, they're doing manual openings, and that makes the opening come back a little bit slower. Again, the theory here is getting the price right is better than opening it as soon as you can right at the open electronically. We'll keep an eye on that. I'll be walking around the floor. I'll give you an update in just a few minutes. Guys, back to you.
Thank you. Good Monday morning, everyone. I'm Carl Quintanilla, live at Post 9 of the New York Stock Exchange, along with Mike Santoli. Faber has the morning off. We're going to see Sarah Eisen around the closing bell this afternoon, along with the White House presser at 3:30. It's another tough day for stocks. Circuit breakers did halt trade for 15 minutes at the open. Mike, you had some good perspective on I don't know, are we using the word crash even though it's happened over a series of a couple of weeks?
Yeah, I think it's almost more appropriate to use crash just because of how vertical it's been, almost 30% in 3 weeks. So slow motion crash or really fast plunge into a bear market, however you want to talk about it. I do think that one aspect of a bear market is duration. It's the kind of way that we all kind of reorient ourselves around this. And one of the distinguishing things about the current episode is it came from an all-time high. I mean, even if I keep talking about, October of 2008 and all that stuff. By the time Lehman Brothers failed, the S&P was already down 20% from its high almost a year earlier. So there was a grind to it. This is much more of a sudden stop, just the way the economy has. And it's interesting because the market is always going to try and race to price in its best guess of the future, and often is going to overshoot when it does that. The problem is you're now having a market that's overshooting an intentional overreaction by economic actors, right, and by governments. You're really almost hoping that it looks like an overreaction so that this actually gets under control. So I do think that's one of the things that makes this very difficult to handicap and also compare to prior instances.
Yeah. All right. So given what you just said, what do the levels that held a few moments ago for now tell you?
Well, I think one thing to keep in mind is that crazy last half-hour ramp we had on Friday was almost going to be unwound over the weekend no matter what, in my view, at least tested. And so I do think that right now we're a few percent below where we closed on Thursday, and we're hanging out here for a while. I think those December 2018 lows are going to be significant, around 2350, though, if in fact we get another wave of selling here. I think we do want to get out to Steve Leisman with the Fed making that emergency rate cut move yesterday, as well as some other measures. Steve?
Yeah, Mike, thanks very much. So the day after that absolutely historic moves by the Fed, where essentially what they did is they took a bunch of stuff they did during the financial crisis era over a series of weeks and months, did it all really in one night. Maybe more yet to come. People I'm talking to in the markets right now are really waiting and watching for the impact of what they did last night to show up. It certainly hasn't shown up in the stock market. Although one person said to me, can you imagine where the market would be right now if the Fed had not done what it did last night? But they are still waiting for some improvement in some of the spread, some of the relative value of cash to futures market in the Treasury, some of the more esoteric derivative numbers that have blown out. But what they really want is they want the Fed to come into the commercial paper market. And there's a lot of concern about what's happening there and companies' abilities to finance themselves. That's something that they're going to have to do ostensibly with the Treasury. A lot of talk about that. Let me go over quickly what the Fed did in case you're just catching up here. It cut rates to zero, full percentage point cut, $700 billion of asset purchases. And indeed, they're waiting for that to happen today. $40 billion will be spread out over the day. We'll have to see as these operations occur if there's any improvement in markets. They slash reserve requirements to zero for thousands of banks, and they ease the terms and the rates at the discount window and on these dollar swap lines. Guys, we were in the field with a survey, a Fed survey, before the Fed took these actions, and I want to show you where they put the recession probability, which is now 67% according to our Fed survey. It's the highest we've ever had in the 10 years we've been doing this, and that's up from 41%. That's the probability of a recession in the next 12 months. Now, let me show you, because we asked for the first time here, the growth trajectory expected by our 40 respondents. And this is very telling because it's very similar to what Fed Chair Jay Powell talked about last night. A modest first quarter growth, an actual decline in growth in the second quarter, about flat next quarter, and then the rebound happens in the fourth quarter. This is 6 months later than anybody was ever talking about. I want to say as recently as 2 weeks ago or a week ago, but now the outlook is for an outright decline in the second quarter. And essentially what Fed Chair Jay Powell said last night is the third quarter is up in the air relative to the spread of the virus and the amount of economic activity that has to be reduced in order to keep it from spreading. Carl?
Steve, I mean, 67%. Do you wonder what the other 33 are thinking?
I think they're thinking we can just barely avoid it. Look, a recession is not really 2 negative quarters of growth. A recession is when the National Bureau of Economic Research meets and determines that you've had a prolonged, protracted, and pervasive decline in economic activity through a whole bunch of different metrics. So it's possible to technically avoid. I've heard analogies this morning, Carl, to the 1980 recession, a short, sharp drop followed by a quick rebound. It was long enough to count as a recession, but it was short, although severe. That's one analogy I read this morning. It's possible that some people think that the combination of Fed policy and fiscal policy can help us avoid an actual recession. But as you see from that graphic, there's a large percentage of people who don't think that's possible at this point.
Steve, one other thing, of course, we all remember from the financial crisis was the Fed and other, parts of the government attempting to stem the spiral and trying to come out with measures, and the market either liking it or not liking it, and they had to go to the next step. This idea that perhaps pretty much everybody expects something with regard to commercial paper backstop to happen. Did that not happen this time because perhaps the Fed didn't feel it was necessary yet, or because it just couldn't be put together in time?
I think it's more the latter. Somebody described it to me, and this is not inside the Fed, but outside the Fed, is probably a bandwidth issue. As you saw, Mike, from the list of things that we put up there, the Federal Reserve did an awful lot last night. This thing with commercial paper, I believe, requires approval of the Treasury. They ought to be getting together and doing this. I've heard people talk about the need for absolutely targeted relief to specific industries. Healthcare and the airline industry are two that were brought up. The Fed can do this, but it needs to do it with Treasury. There have been some changes to the Fed's emergency authority after the Dodd-Frank bill, so they need to do that. I've heard talk, or there's one idea that I actually had, which is to eliminate the stress test. I don't think, Mike, at this point we have a problem with bank solvency, and I think that's something we're going to have to watch very carefully. But the banks are set to be well capitalized. I think the Fed is going to have to work to keep it that way.
Steve, thank you. We will talk to you often today. Our Steve Leisman working remotely. We did trigger the first circuit breaker if you're just joining us at 25:21. We won't trigger the second until 23:58. So almost 100 points below levels that we're at right now. We're joined by Wells Fargo Asset Management Senior Economist Mark Vidner this morning on the CNBC Newsline as well. Citi Private Bank Chief Investment Strategist Stephen Whiting. Gentlemen, thank you for your time today. We appreciate it. Well, we know
Good morning.
With everything else going on, it's truly valuable to our viewers. Mark, I want to ask you, as Leisman just said, deep and short. That's the phrase we keep hearing out of Deutsche, Goldman with similar comments. Is that naive?
I don't know that it's naive. We didn't have any obvious imbalances going into this crisis. Housing wasn't overbuilt. Commercial construction wasn't overbuilt. Businesses didn't overinvest in plant and equipment. Household balance sheets were in really good shape. The savings rate was 8%. So the typical cyclical imbalances that lead to a deep and prolonged recession just don't exist. And so I do think that we're probably looking at a pretty sharp contraction in the second quarter. And you really want to look at a range of outcomes, so maybe something like 3 to 5%. And the third quarter, it depends. It depends on how this virus progresses.
That's not the first time. I think Goldman's going with the number 5 as well. Stephen, to the degree you can address the next couple of quarters, where are you and what kind of assumptions are you making?
Well, look, flattening the curve to prevent overwhelming our healthcare system means that you deepen the economic impact. And so these are really unprecedented lockdowns of economies. It's happening sort of top down in Europe. It's following a pattern that you saw in China. In some respects, not as severe. In other respects, more severe. And it's happening sort of bottom up right now in the U.S. economy, where anybody responsible for people is making this happen. So it's going to be an incredibly severe drop for travel, hospitality, all of these sorts of things, and discretionary spending. But, just as Mark had said, this is not an economic deterioration. As Steve Leisman said, this is not an undercapitalized banking system, not a financial crisis. So where the third quarter comes out really does depend on the policy response. Can you sort of, build a bridge over this coronavirus depression over a short period of time? And then if you haven't really harmed economic capacity, if you haven't had a chain of defaults from the actors who have been so hurt by this, then you can have a sharp recovery. So it's really critical now to get the fiscal response, now that we've seen monetary policymakers make it even easier to borrow.
Right. That's a very tough balance. Mark, where do you think the market wants to see that second derivative on the health curve? Does that have to be an April story?
It would certainly help if it was an April or early May story. I mean, I think we're hearing 4 to 8 weeks, and the CDC is recommending social distancing for 8 weeks. So I think that certainly somewhere in the ballpark there, we have to see that we've gotten that second derivative and that the number of new cases is growing at a slower rate. I also would like to reiterate, though, on consumer spending, I know it feels like everything is absolutely stopped, but 2/3 of consumer spending is effectively on autopilot. Our biggest point of consumption is housing, which is your consumption of housing or the rent of housing. And then you've got utilities, insurance, and things that cable, which cable or whatever you're cutting the cable service is.
Sure.
You've got all of that type of spending, which is likely to continue. So that's something that's a little bit different in the U.S. Well, it's very different in the U.S. than in China.
My paycheck up to two.
Stephen, obviously markets are not really equipped to, in any kind of precise way, try to handicap and discount this type of sudden stop. How, as an investor, should one approach this right now? I mean, normally, I guess long-term investors say, look, I'm in the business perhaps of buying a 25% break or slowly buying a very dramatic decline in equity values that wipe away a couple of years' worth of gains. But we simply don't know what the next step is or how deep this has to get. So what do you think markets are right now pricing in, and how should investors treat them?
Well, it's disorder at the moment, and again, for equity investors, for institutional equity, managers, I think we should look a little bit to credit markets. We should see, obviously, the Fed is trying to address something that's malfunctioning, but you've got to take, that into account. The fact that corporate bonds, even investment-grade bonds outside of the energy area, have seen bids and offers, far apart. This dysfunction, right, which we last saw in the financial crisis, even though our underpinnings are completely different, over the short run, that adds a great deal of volatility and downside risk to equity markets. But certainly, yes, we will overshoot here. And, if this is not going to be something where the economy's capacity to rebound is broken, you end up with great returns 12 months out. But I think you've got to be careful about saying, any line in the sand about where exactly, to price an asset when markets are dysfunctional over a short period of time.
Yeah. Mark, as we're talking, Reuters with an Energy Department source, U.S. could start purchasing crude for the SPR in as soon as 2 weeks, could, within months, purchase 77 million barrels of U.S. produced crude. I don't know how much you can delve into the energy markets, but what kind of contribution could that be?
It certainly helps a little bit. I don't know that that's going to reverse the prices, because really what's happening in all asset markets right now, in commodity markets, is that it's the absence of information that is sending prices lower. And so this helps. And from an individual standpoint, this is great. Normally when the government's adding to the stockpile, they do it at higher prices. So it's nice to see them doing it at rock bottom prices.
Mike?
Steve, anywhere around the world kind of gotten to this point beforehand? Are there any models, at least in terms of how the economic shock might be absorbed, that you have your eye on that perhaps we can anchor to?
Well, I think, we're looking at China. In some respects, again, because of the Lunar New Year migrations, their factory shutdown was unbelievably sharp. It was extremely sharp. But so what we're seeing, again, is a bit of a repeat of the social distancing in China, but in places where we're not used to it. It may be less effective. So we might find, again, larger disruptions in some places in these Western economies, including the United States, and in other areas, it's just not going to be quite as severe. But China is making a rebound right now from this. Again, social distancing is becoming less severe. Governments are putting people back to work. We still think that there are negative second-order impacts of the trade shock around the world that will slow down China in the rebound phase, and the possibility of reinfection is there. But at least, again, in many respects, what we are is following, China with a 1-month lag. And, again, in an optimistic scenario, with all of the steps we might take, to protect the affected parties who are going to lose income over this period, it's possible we could follow that. In financial markets, again, in some of the Asian markets have actually outperformed a bit. I think we can tentatively, very, very tentatively, look to that and hope a bit that we could follow that path out of this.
Yeah, I'm actually a little more optimistic than the China case, because I think where we're seeing a comparable shutdown is in the travel and leisure sector, and that will pop back pretty quickly. We're much more service-based and in professional services. I think a lot more of that work will be able to get done remotely, and we won't see as dramatic a pullback in our service sector as we saw in China's manufacturing sector.
That's a good point, Mark. Certainly the ability to work remotely, as we show our viewers every day, is a silver lining. Mark, Steven, stay healthy, guys. Talk to you soon.
Thank you.
Well, as cases of the coronavirus keep growing, one hospital in Chicago is doing its best to screen as many patients as possible. Recently, Rush University Medical Center set up these tents raised over its emergency department's ambulance locations, which creates an area for testing potential COVID-19 patients in isolation from general patients. And joining us on the CNBC Newsline is Dr. Omar Latif. He's CEO and president at Rush University Medical Center. Doctor, thank you very much for calling in this morning. Clearly, you are preparing for a surge in potential new cases, in people getting screened. What are you seeing right now in terms of infection rates and volumes of people getting tested, and what do you anticipate?
Well, thank you for having me. What we're seeing is a lot more action and a lot more concerned patients coming in and presumptive cases being diagnosed every day. We have a doubling in the state of Illinois over the last 2 days. So what we're seeing is a continued increase in the numbers. So we're on the way up of the curve for infected patients.